If these policies and these tariffs stay in place, then we will have a recession with a very high probability.
The president only gets out of this if he in a credible way commits to self-limit.
I don't know that it's too late to pull out of that swoon, but we've been getting pretty close.
The sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data.
I'm optimistic in the longer term about the U.S. economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into the IMF spring meetings, and the White House is pushing for deals.
We're very optimistic about China and especially optimistic about just about everybody else. The fact that we've got a sketch of a fantastic deal already in place with India means that the president is showing leadership to the world. We've got virtually every country on earth negotiating with us right now. We've got the Chinese open to talks already. The president has moved the world in a way that is unprecedented, and it's in the direction of the American worker.
So how optimistic should we be? The Journal reporting the president is considering slashing tariffs on China, in some cases by more than half.
I haven't brought it down. I haven't brought it still 145. It basically means China's not doing any business with us. But we get along. I get along very well with President Xi, and I hope we can make a deal. Otherwise, we'll set a price, and hopefully they'll come here and they'll contribute. And if they don't, that's okay.
The clock is ticking, and the nation's biggest retailers are piling on the pressure. Walmart, Target, Home Depot, all warning President Trump that his policies could raise prices and empty shelves. And that could happen, Lisa, within weeks.
This is the problem. The cat's out of the bag. There already are ships that have not gone out of China, and we are seeing a situation where the delays will happen when it comes to the shelves. The issue is, when you listen to what companies actually say, tariffs came up 107 times in the Beige report. You're looking at the idea of uncertainty 89 times. This is something that's pervasive among companies.
So let's talk about where we are right now. So the Wall Street Journal has come out with that report saying we're getting ready to slash tariffs on China. The Treasury Secretary, Scott Bessent, has said this won't be done unilaterally. Then the president said if they don't make a deal, we'll set the tariff for them. Make sense of that.
Well, they already set the tariff at 145%. Clearly, Jonathan, you said this yesterday, what we see out of China, we see out of this White House is that they're negotiating with themselves when it comes to China. Well, China responds this morning, and they're basically calling this fake news when it comes to any sort of negotiations, and said that there haven't been any on any level, and they're waiting for a rational voice to lead this. And China has been calling for that. One, to dial back the rhetoric from Washington, D.C., and two, appoint someone that we can have these negotiations with.
Equities doing better over the previous 2 days on the S&P 500. A slight pullback this morning by 0.4%. And another revision on Wall Street, this time from Binky Charter at Deutsche Bank, down to 6150 on the S&P. That's a cut from 7K. It's been a year full of revisions. Coming up on this program, we'll talk about a few of them. We'll catch up with Yardeni of Yardeni Research as stocks post back-to-back gains. We'll catch up with the Norway Wealth Fund CEO, Nicolai Tangen, on a roller coaster first quarter. And we'll speak to the Manpowergroup CEO, Jonas, Prising on labour market uncertainty. We begin this hour with stocks lower, following powerful back-to-back gains on the S&P 500. For an update on trade negotiations, joining us now from the White House is Bloomberg's Tyler Kendall. Good morning, Tyler. What's the latest?
Yeah, good morning, John. Well, still some mixed signals from this White House, particularly when it comes to negotiations with China. You heard President Trump there reiterate he thinks the 145% levy is very high and amounts to a trade embargo, but at the same time said that if the U.S. does not reach a deal with Beijing, then that would be okay because the White House is prepared to set what he called a, quote, fair price. He then went on to suggest that the administration is preparing to release revised tariff rates for countries, including China, within the next 2 to 3 weeks. Those comments coming after the Treasury Secretary Scott Bessent said that the U.S. was not prepared to remove tariff barriers on China on a unilateral basis after that Wall Street Journal report suggested that the White House was going to slash levies on Beijing in a bid to de-escalate tensions. And that's exactly what China's Foreign Commerce Ministry said should happen this morning, denying that any such negotiations are currently happening between Washington and Beijing. When asked yesterday whether or not he was actively engaged in negotiations with China, China. President Trump said that, quote, everything is active. And John, perhaps we can take everything to mean countries and companies alike. You mentioned at the top there, big box retailers here on Monday, urging the president to proceed with caution, but also new reporting from Bloomberg News that the auto sector might be in for some potential reprieves. A few proposals on the table our reporting indicates, but one such could be that USMCA compliant auto parts might be fully exempted, essentially abandoning plans that we were expecting to go into place that would have tariffed non-U.S. content within them. John, we'll have to see how this shakes out. A source familiar tells Bloomberg News that nothing is quite decided just yet.
Tyler Kendall, stay close from the nation's capital, down here in Washington, D.C., outside of the White House. You'll hear more from Tyler later on this hour. Joining us now, Ed Yardeni of Yardeni Research. He writes Trump and Besant discarded some of their best cards while preparing to play tariff poker with China. Financial markets are happy that Team Trump is blinking. Ed Yardeni joins us now for more. Ed, welcome to the programme. Let's talk about the extent of that blink. How much of a U-turn are you expecting in the next several weeks?
Well, it's a very odd situation where the United States seems to be negotiating with itself. It's a very peculiar art of the deal where you walk in the room and you're the only one in there, and you keep issuing press releases saying that great progress is being made. So I don't really know what to make of it. What I do make of it is that clearly the financial markets have had a big impact on the administration. This is the bond vigilantes and the stock vigilantes ganging up on the administration and saying, we need some moderation here, we need some cooling off, and that's exactly what the administration is doing.
And Ed, it's the Target, Home Depot and Walmart vigilantes as well. Clearly, the most important meeting that took place in Washington this week were the retailers sitting down with the President of the United States and warning him that within weeks we could have empty shelves. And Ed, I think it makes it difficult at this moment to read the economic data. What is a genuine rebuild in inventories? What is a genuine, sustainable underlying trend in demand? Ed, what do you see in both the data and the earnings?
Well, the earnings are actually starting to be cut back, of course. Analysts have finally gotten the recession tariff memo, so they've started to incorporate the fact that this isn't going to be good for the economy. It's going to weigh on the economy. I think to the extent that, analysts usually talk just to companies. They don't talk to economists, but they're reading the headlines and they see that economists are lowering their outlook for economic growth, and they're probably getting that kind of guidance from some of their companies that if the tariffs stay on, the longer they stay on, the weaker the economy is going to be. But I think at the rate at which the administration is backing off here, the economic impact of the tariffs could start to really ease off by the second half of the year, which is at this point when most economists expecting a much weaker economy or actually a recession. So there could be a reversal, at least in the soft data, that then would suddenly lift the pressure off the hard data.
And it feels like the genie is sort of out of the bottle, but we can't see him. We don't know how big he is. We don't know whether he can climb back into the bottle at any given time. I just wonder, as you look forward, why you reject the idea that what we're seeing right now is a long-term structural loss of U.S. exceptionalism that will result in a weaker dollar and potentially less dynamism in U.S. equities over time.
Yeah, that's a great question. I mean, it's only a few months ago that the American exceptionalism made the front cover of The Economist. I think it was October of last year. There was a wad of dollars that looked like a rocket ship, and we couldn't be stopped. Look, I think now that everybody's having second thoughts about that, or even concluding in a dire way that the dollar's is in decline here as a reserve currency, keep in mind that there's nothing like the U.S. capital markets. When you make a list of exceptionalism, American capital markets are exceptional. They are huge. They are liquid. There's nothing like them. So I don't know how the dollar loses its reserve status, and I think it remains strong. Even this recent hysteria about the weaker dollar, it fell about 10% using the dollar index, the DXY, that everybody watches. But a much better index that the Fed calculates is down about half as much, which is no big deal in my opinion.
Ed, this is the reason why people are looking at announcements from a number of different asset allocators and seeing if they are trying to diversify even a little bit away from the United States into other countries. I just wonder how concerned you are about the idea that 44% of S&P 500 companies that have reported so far have mentioned the word recession. It's up from 3% in the fourth quarter at a time where potentially the U.S.'s ability to borrow, to bolster the economy in any kind of downturn could really be a lot more difficult, a lot more pricey, a lot more punitive.
Yeah, well, I think the stock market's discounted certainly a weakening in the economy in the second half of the year. We certainly lowered our numbers from something like 2.5% to 3% growth this year to something more like 0.5% to 1.5%. The only question is whether there should be negative signs on those numbers, and some people, I guess, are in that camp. We're still looking at a 45% odds of an outright recession. We think the the administration is going to back off as they have been on these tariffs. And to the extent that they don't, I think they're going to declare victory. I think they're going to get maybe 90 pieces of paper from 90 countries signed by key diplomats laying out a groundwork, a framework. You can't negotiate a treaty in 90 days. You can't implement the treaty in 90 days. But I think they're going to declare victory and move on to the extension of the tax cuts, and life will go on.
Ed, when it comes to the tariffs, though, the Wall Street Journal reported the administration might back down on China to, say, 60%. But that is what Trump has been saying for months. On the campaign trail, he promised 10% across the board, 60% on China. So if that's the base case, how does this economy look?
Well, as you know, it's hard to define what the base case is. It changes almost daily from the press conferences that the president has in the Oval Office. His associates keep talking about how much progress they're making. So I think 60% is just as prohibitive as 145%. I think they're going to have to, again, negotiate against themselves and maybe postpone that increase. So they'll leave it at 60%, but they're going to postpone it for 90 days, turn down the rhetoric, and find somebody to negotiate with the Chinese on a better deal.
Ed, just a final question from us. You've been super constructive on this cycle for quite a while. Coming into the 2020s, you talked about the roaring 20s.
Yep.
We're at the halfway point, working through that now. Ed, have you thrown in the towel on that view, or are you sticking with it?
Well, John, it was a great first half of the decade. I hope it's the roaring 2020s isn't over yet. There is sort of deja vu with the 1920s. We got a whole decade out of that before the Congress horrendously imposed tariffs. So there's a certain similarity here, but I think this too shall pass. And I'm still looking for the roaring 2020s to be a description of the entire decade. Call me an optimist, but I think, I guess my mantra has been, look how well the U.S. economy has done over the years despite Washington. That's still my bet.
Ed, we hope you're right. It's good to catch up with you, sir, as always. Ed Yardeni there of Yardeni Research. If you are just joining us, welcome to the programme. 2 days of gains on the S&P, just a little bit softer so far this morning. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Yahira Hackett. So, Yahira.
Hi, John. The Trump administration is considering reducing certain tariffs on the auto industry. A measure being discussed would spare autos and car parts that are already subject to levies on steel and aluminum imports to avoid doubling up. Another option would fully exempt auto parts that comply with the U.S. Mexico-Canada trade pact. President Trump is ramping up pressure on Ukraine President Volodymyr Zelensky to accept a peace deal, accusing him of prolonging the war. The U.S. proposed a deal that would effectively freeze the conflict, acknowledge Russia's occupation of Crimea, and ease sanctions on Moscow. But Ukraine and Europe want assurances of a ceasefire and security guarantees. And shares of Texas Instruments are surging in the pre-market, up 8.4% now after the company gave a better than expected forecast for the current period, thanks to increased demand for industrial and automotive components. Texas Instruments is working to navigate the impact of tariffs, including shifting manufacturing to new facilities. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. That's the outlook from Texas Instruments. This from PepsiCo just moments ago. Pepsi downgrading the outlook, cutting the outlook, and the stock is falling. We're down by about 2% in the pre-market. We'll have more on their story later on this hour. Up next on the programme, policy volatility in Washington.
We've seen a valuation adjustment largely in the more expensive parts of the market as a result of the policy uncertainty. We've become way overexposed to the United States as global investors.
Up next on the programme, we'll catch up with the Norway Wealth Fund CEO, Nicolai Tangen, from New York City and Washington, D.C. This is Bloomberg. Live from Washington, welcome to the programme. Good morning to you. Equity futures on the S&P 500 just a touch softer following 2 days of powerful gains on the S&P. We're negative by 0.4% on the S&P. On the Nasdaq, we're down by 0.5%. Under surveillance this morning, policy volatility in Washington.
We've seen a valuation adjustment largely in the more expensive parts of the market as a result of the policy uncertainty. We've become way overexposed to the United States as global investors. And some of that was by design, American exceptionalism. Some of that was just by market moves. Right now, we're really more on the whims of the White House and waiting to see ultimately what that's going to look like. So it's hard for markets to get a footing.
Here's the latest this morning. It's been a challenging start to the year for many, including Norway's Sovereign Wealth Fund, reporting its biggest loss in 6 quarters, due in large part to a drop in US tech valuations. To discuss, I'm pleased to say the Norges Bank Investment Management CEO, Nicolai Tangen, joins us now for more. Nicolai, welcome back to the programme, sir. A lot has changed since we last spoke. Attitudes towards US assets are starting to shift. I just wonder how you and the team have started to think about that, how you're debating that issue internally over in Norway.
Well, we have a very long-term view on what we do. So, we are invested with roughly half the fund in the U.S., and we are here for the very long term. So we have not made any major adjustments lately.
So, Nicolai, can I read into that you view this as just a shock to the cycle and maybe not a long-term shock to the system?
Well, I think it's very, very difficult to say, because when we make scenario analysis here, one of the negative things that we see is that if you get a disentanglement between the two major trading blocks, that's really, really negative, because it slows down growth, increases inflation and so on. So it is potentially one of the really negative things that can happen here. So I think the outlook for markets are very, very uncertain.
Given that there has been a shift, Nicolai, to move at least a little bit of assets among large asset allocators out of the United States, diversify to places like China, to India, to Europe, why aren't you doing the same and shifting to benchmarks that have a little bit more exposure elsewhere?
Well, we actually are extremely well diversified already. We own 1.5% of all the listed equities in the world. In Europe, we have more. We have close to 3%. And so in the US, we have 1.5%, and we also have the same in the rest of the world. So I would say we are well diversified, 70% equities, 30% bonds, and we also have a very, very good real estate portfolio, which is coming in really handy here.
Well, Nicolai, you said previously this morning when you were speaking to media in Oslo that you will correct the underweight to U.S. stocks. So you are planning to reinvest in U.S. stocks, even though you are surprised that we haven't seen even more weakness. Why are you redeploying all of the money that maybe has lost in terms of benchmark allocation to U.S. equities, given some of these larger uncertainties?
Well, the kind of the increased allocation to the U.S. is part of a program that we've been doing for quite some time. We still have some work to do here, and that we will continue to do. And we think the large American companies are just great long-term investments, and so we are very happy to be invested there.
What sectors? Can you give us a little bit of a hint of specifically the sectors or the companies you're interested in the United States?
Well, we are quite index near in how we are invested in the U.S. So we typically have large holdings in the big tech companies, in all your large companies really, and we made a lot of money there over the last few years. Of course, so far this year it's been negative, but when you look in comparison to the gains we've had last year and the year before, we've given back in a way surprisingly little, I would say.
What about defensive companies like Lockheed Martin? Is that going to be open for business when it comes to the sovereign wealth fund?
Well, we invest in a lot of different industries. We have less exposure to the defense industry, but we are in a lot of the defensive names as well.
Nicolai, one word you often use with us is we are diversified. I just wonder if the meaning of that word has shifted over time, particularly this year. The Treasury market is behaving in unpredictable ways. When the equity market is falling, Treasury markets have fell as well. In fact, those two asset classes are trading in lockstep at the moment. It's as if investors are treating all dollar-denominated assets as one bucket. And I just wonder, Nicolai, what that means for how you think about diversification this year and beyond.
Yeah, there were some times when this type of diversification worked less well. We had the same type of situation, 2-3 years ago. And so some years it works, some years it doesn't. I think over time, if you have a really long-term time horizon, I think it's the right positioning to have.
We've seen over the last month or so that some investors were trying to understand whether what was happening in the Treasury market was just trades unwinding, some hedge funds blowing up, or, Nicolai, whether it was a reassessment of the safe haven status of the United States. Nicolai, what's on your dashboard to help distinguish between one and the other? What do you think it was? What do you think it is?
Well, I think it's a very, very complicated question. I don't think it's only one thing. I think it's a cocktail of all the kind of things you mentioned. Now, so far this year, we have been neutral to the U.S. Treasury market. We have not reduced or increased positions, so we have certainly not caused that move.
Do you have a sense, Nicolai, going forward, of whether we are entering a more inflationary period, given some of the deglobalization that we're seeing, some of the fissures and some of the kinks that are emerging in the supply chain system?
Yeah, I think we are potentially going into a more inflationary situation. It is kind of a pretty obvious consequence of higher tariffs. And of course, inflation is really negative for markets. So I think that's potentially one of the big risks that we are seeing just now. Interestingly, we just yesterday released a podcast with Ken Rogoff, kind of the world leading specialist, I guess, on inflation. And he's also very worried about this particular fact.
Well, I guess that just to build on what John was asking about, the idea of diversification, and you have been about neutral on U.S. bonds, there has been a feeling that maybe diversification, especially in an inflationary environment, requires some gold, requires some alternative assets that might be asset-based funding that have different streams of diversified revenues. Is that your take on it, that you just on the margins want to pick up a little bit more gold or diversify a little bit more in some of these other asset classes?
Yeah, so we have a very strict mandate here from the ministry. So we cannot buy gold, and I do think gold sometimes is a bit difficult to understand what the intrinsic value is of gold. We also don't do cryptocurrencies, for instance. But when we look at alternative assets, I would say in a market like this to have real estate, that's very good. We have just under 1,000 properties around the world, large holdings in Manhattan, Boston, Washington, and so on. And so I think that's going to be a pretty good place to be going forward.
Nicolai, appreciate your take at a difficult time. Thanks for your time this morning. Nicolai Tangen there, the Norway Wealth Fund CEO, on a difficult moment. It wasn't him. He wasn't selling treasuries, seems to be the takeaway, Lisa, from that conversation.
Yeah, and this has been sort of a big mystery. Who has been the person selling treasuries? Has it been foreign holdings? How many notes have we all gotten from people saying, actually, the foreign investor has been there. They've been looking. And yet some of the commentary overnight, particularly from Deutsche Bank, George Saravello, saying that he sees a long-term weakening in the dollar. You heard a similar type of peak U.S. equity valuation from Jefferies. It just raises this question. How much is this media narrative and how much is this reality?
The bond market reality right now, we're doing better, settling down, a bit of stability. Yields are lower across the curve. On the 10-year, we're down 4 basis points to 4.34. Up next on the programme, we'll catch up with the former IMF First Deputy Managing Director, John Lipsky, as tariff concerns continue to whipsaw markets worldwide. Live from Washington, D.C. in the nation's capital this morning for the IMF World Bank Spring meetings, this is Bloomberg Surveillance. 2 days of powerful gains on the S&P 500. Over that period, a gain of more than 4%. In just 2 sessions. This morning, negative. We're down by 0.4%. On the Nasdaq, we're down by 0.5. 3 hours away from the opening bell. Let's get your morning movers over in New York City with Danny Berger. Hey, Danny.
Hey, John. We got some earnings to get through, and look, you're going to be hard pressed to find any company that isn't mentioning something along the lines of macro policy uncertainty. That's what IBM gave us, and those shares are down nearly 7.5%. The earnings themselves, the top line, a beat basically everywhere, but saying that businesses are starting to rethink their spend. And also government spending, that already pulling back means that some of their government consulting contracts are getting hit hard, hence the reaction. We also heard from Pepsi just in the last 30 minutes or so, cutting their full year outlook. They now see their earnings flat for 2025 versus 2024. Again, pointing to volatility as specifically in trade policy, saying that it's leading to higher costs. So those shares down 1.33%. Finally, Chipotle. Now, this one was specifically interesting because, again, all these companies, they're warning on things to come, not the here and the now. That is different for Chipotle, posting a sales decline for the first time in 5 quarters. Shares are down 3.8%. The commentary from the executive suite over there saying that consumers are concerned. They're trying to save money because they don't know what's to come. So shares falling 3.8% this morning, John.
Hey, Danny, thank you. More from Danny later on this morning. 3 of the names you need to watch before the opening bell. On our radar this morning, our top story, China demanding that the US revoke all unilateral tariffs and saying there have been no talks to reach a trade deal. This coming after comments from President Donald Trump earlier this week, signaling that he could lower tariffs on China, but China would have to come to the table. And from what we hear from China, they're not at the table.
One reason why they're not is because they're looking for a point person. And it seems like maybe they're looking for one particular point person, which maybe they'll get, maybe in the words of one Republican Congress member, they think that they're dealing with Besant, but they really are ultimately just dealing with President Trump. This is the challenge right now. How much can this market really get behind any shifts, pivots, given there's a lot of work that still has to be done?
Why would China come to the table at this moment when already there are reports and the president himself saying their tariff rate is not going to be as high as 145%? They are going to play the long game as long as possible. And the issue that this administration has, they have a midterm election in 2026. So they are trying to put out the olive branch and get China to make this phone call to start these negotiations. But China is saying, actually, we can wait this out a little bit longer.
So the general reporting, basically what you've been saying repeatedly over the last several months, which is where we'll end up here is what he promised on the campaign trail. 10% across-the-board tariff with something bigger on China, say 50 or 60. Then the president is basically saying that he wants to negotiate with China. If they don't negotiate with him, he'll set the tariff. Now, can you make sense of that?
Well, the tariff is at 145%. Maybe he's saying I'm willing to loosen the tariff, set it at a lower rate. But what President Trump has said repeatedly on the campaign trail is exactly where people are predicting the rates will level out. So what you saw him do is come into the office, set a maximalist approach, try to get as much concessions he can from trading partners and from China as well, and then it's going to settle to where he's always planned. So if you just listen to what he says, maybe that's a tea leaf of the destination.
You mentioned the midterms. They've got to do something with taxes. Here's the latest on that front. The president pouring some freezing cold water on the millionaire tax, saying the 40% tax bracket would spur the country's wealthiest to leave the country. Lawmakers will return to Washington next week to begin debating tax package details. And that's something some Republicans have actually been open to over the past few weeks.
They have been open to it because this is something that they can definitely use when it comes to the midterm elections. Yes, we're looking at cutting some social programs or on the margins, trying to get some of the fat out of the budget. But at the same time, we're looking at raising taxes. The issue is, even though we are on a populist wave in America, there is not going to be many conservatives that say we are willing to raise taxes on anyone. Someone close to the Trump administration, though, when the story first reported by Bloomberg came out, said, look, it's not going to happen to individuals that are making over $1 million. Maybe those that are making hundreds and hundreds of millions of dollars.
But it shows the difficulty right now. And among those Republicans who are supporting this is moderate Republican Chuck Grassley. If they don't do this, do they have to cut Medicaid? Do they have to cut Social Security? And if they don't, oh, wait a second, does the bond market start caring about the tax plan again? Because suddenly we're talking about the deficit. So at this point, they're kind of between a rock and a hard place with a lot of constraints on how they can raise revenue.
The bond market right now, at least stable this morning, yields a bit lower across the curve. Some companies have a tariff problem. Some companies just have a Gucci problem. Sales from Kering's Gucci dropping 25% in the first quarter. Kering expecting a better second half of the year and planning to protect its margins by upping prices as tariffs take effect in the US. The stock is down by 4.5%. 5%. Blaming this on trade is wide of the mark. They've had a Gucci problem for quite a while.
They have a Gucci problem. They now have a new creative director, which he really is someone that is fraught with a lot of controversy. So we'll have to see whether or not he's able to really turn this ship around. The Gucci on the sales call, on the earnings call, was talking about the fact that we'll start to see Demna, the creative director from Balenciaga, we'll start to see some of his influence by September. Will that be enough? The issue this company has is that once Kering goes, it's going to be very challenging for the entire group to spend.
Kering is down in the pre-market by 4.5%. Equity futures negative here by 0.25% and recovering. Stocks coming off 2 days of gains on renewed tariff concerns. The former IMF First Deputy Managing Director, John Lipsky, writing, while there have been some pullback from the financial market weakness late last week, there is ample reason to expect heightened risk premia in US markets going forward from here. I'm pleased to say that joining us here in Washington is John Lipsky himself. John, good morning. It's good to see you.
Morning, John. Happy to be here.
It's great to catch up with you. I wanted to reflect on the words of Treasury Secretary Scott Bessent just yesterday in an address to the IIF, talking about mission creep of the International Monetary Fund, something you've heard many times before. Yes. How do you expect these institutions to work alongside this White House?
Well, they've done it before. During the Trump administration, it may be forgotten that a capital increase was approved for the World Bank, and the largest program ever from the fund for Argentina was approved with the strong support of the Trump administration. This message of no more woke focus, if you will, began with the Biden administration, with a speech from the Undersecretary of the Treasury in let's get back to basics was the theme. So what we heard yesterday wasn't new, but what was new was a clarification of the commitment of the Trump administration. As I said, he said American leadership in this area, but this means America's committed to these institutions. And we all remember reading Project 2025, where it recommends let's get out of those institutions. So this is, I think, will be taken as non-trivial.
And technically, that review is still underway, but it sounds like from the Treasury Secretary they're committed to the IMF. He also went on to say, we will not abide by the IMF failing to critique the countries that need it most, principally surplus countries. In line with its core mandate, the IMF needs to call out countries like China. Do you think the IMF is doing a good enough job calling out China?
Well, let's start from the basics, which is it's very hard to force surplus countries into doing anything. They are accumulating reserves and have a lot of flexibility. This is a basic problem of the international system. How do you balance the need for adjustment from deficit countries and surplus countries? Now, the IMF for years has been calling out the mix of policies in China and saying they need to readjust away from the external sector toward domestic demand, et cetera, et cetera. This has been an ongoing theme. So it's if you've been looking at the documents, you understand the fund has been trying to encourage the Chinese to move their policies in that direction. What's enough? What's effective? That's a one we could discuss.
Do you think the Trump administration's policy cocktail, basically, when it comes to China, putting up the walls, could work and help rebalance their economy?
Certainly, the Chinese authorities will undertake an adjustment if they perceive it's in their own interest. And this is the debate that has been ongoing for several years, namely that the policies that they have been following have been to the detriment to their own citizens' standard of living. And a different set of policies in China would do better for China. This is an argument in which there are many Chinese who also agree with that. Whether that's going to become effective, external pressures can be useful, but think if it were us in the United States. Just external pressure is not going to produce those kind of profound changes in a huge economy. They have to perceive it's in their interest.
Every year there's an elephant in the room at the IMF meetings. At one point it was China and the sort of imbalance and the inability to really critique China in a really aggressive way. Then it was Trump potentially becoming president again. President Trump did become president again. Now there's this existential threat about whether the IMF will survive and whether it will even survive in its real form. Is it compatible to have the United States threatening to pull out, which potentially could torpedo this organization, and asking for concessions, and the rest of the world not seeing the IMF as simply an extension of U.S. policy?
Well, the Bretton Woods institutions, the bank and the fund, have unique structures. And so far, what makes them unique is they are able to act. And they are able to add, they're structured to be able to act even when there is conflict among the major economies. Now, if we're talking about something as existential as the United States withdrawing from those institutions, you're in a brave new world, and maybe not so brave. You're in a new world. But as has been pointed out, if the U.S. were to withdraw, they would no longer have a say in a key institution in which no one else is talking about withdrawing from membership. So if the U.S. were to step back, it's not clear who would be more hurt, but certainly the U.S. would lose an important voice in a key international institution. I don't think that's sensible, and I don't think it would happen.
And that's definitely the argument that the IMF's MD is making as well, particularly to this administration. I do wonder going forward how much you see another existential threat, which is a potential questioning of central bank independence, even though that potentially was walked back by this administration, and just the sense that maybe people are looking for alternatives, moving slightly away from the U.S. assets in a way that creates some big structural changes to the overall financial system.
Not impossible. We're seeing threats, at least some consideration of threats to the post-war international system that has produced the exceptional economic performance over the past few decades. Now, already there has been a change. From 1950 to 2007, international trade grew faster than global GDP, as was intended. That international trade was boosting global growth. After 2007, after the global financial crisis to last year, trade has grown more slowly than GDP, and the growth in GDP has been the slowest of the extended period of the post-war era. Now, these latest measures threaten to reduce trade, actually decline in trade volumes. What that's going to do to global growth is another question. There needs to be engagement globally, including the U.S., on this situation because, as you can see, investors are not only worried about the economic outlook, but the whole structure of the international system that has provided confidence in the broad design of economic progress. If that were called into question, we'd certainly be beyond anything our economic models are able to handle.
John, as you know, we have a reluctant hegemon, and maybe we can finish on that point. The US believes that maintaining the system in its current form is a net burden, not a net benefit. It's done so in multiple dimensions. It's talked about the security umbrella that it provides without much help from elsewhere and believes that that is a burden. There is one voice in particular within the administration that has questioned continuing the dollar as the reserve currency and looking at that and saying that that is also a net burden for the United States. How would you reflect on that, and what would you say back to U.S. officials?
Oh, I would say that the system has served the U.S. very well. Not perfect. Things can be better. But think of this. This has been a period in with U.S. economic performance. It was only months ago in which the dominant theme was U.S. exceptionalism. So if we take a step back, try to see the forest and not get too concentrated on the trees, we can see this is a system that in which the United States has done not only well, but relatively well. After all, the U.S., let's put it this way, the goal is we'd all rather live with rich neighbors than poor neighbors. And this is a system that has been intended to make everybody better off. It has, by and large, done that with problems. And to back away from that in a way that is profound calls this into question.
John, you're a gentleman. It's good to catch up with you. Thank you, sir.
Thank you. It's always a
Appreciate it.
pleasure.
Thank you. John Lipsky there, the former IMF First Deputy Managing Director. Equity futures on the S&P 500 here just about recovering. We're negative by 0.2%, well off session lows. With an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahira Hekes. Hey, Yahira.
Hi, John. We start with Pepsi, which Danny mentioned earlier. Those shares are falling nearly 0.9% after the company cut its full-year profit outlook, citing uncertainty due to tariffs and consumer spending. Pepsi CEO says the company is actively planning mitigation actions to address higher supply chain costs. And a check on shares of IBM, those are falling in the pre-market even after they reported first quarter earnings that beat estimates. But the CEO expressed caution over the economy and said the government's cost-cutting actions under Doge are hitting its business. About 15 of its federal contracts have been canceled or paused, worth about $100 million in future payments. And President Trump is hosting a dinner for the top 220 holders of his meme coin. The dinner will be held at Trump National Golf Club near Washington on May 22nd. The top 25 Trump coin holders will also be invited to a reception before the dinner with the president and will be given a tour of the White House. That's your Bloomberg Brief. John?
What gets you in the top 25? That's what I want to know. Yahira, thank you. More from Yahira later on in the program. Up next on the program, U.S. economic growth in question.
When you listen to what corporations have been saying up until this point, they're very much sitting on their hands. What we're trying to do is walk through a very foggy forest. We have a sense of where some of the trees are, but we don't have a great sense of whether we're veering off of the path.
Up next on the program, the Manpowergroup CEO, Jonas Prising, live from Washington, D.C. this morning. Good morning. Back-to-back gains on the S&P 500, erasing losses this morning. Equity futures just about negative on the S&P by not even 0.1%. Some very welcome stability in the bond market. 2-year, 10-year, 30-year yields lower, edging lower for a third consecutive session. On the 10-year this morning, we're down 3 basis points. Your yield, 4.3538. Under surveillance this morning, U.S. economic growth in question.
We're also not looking at terribly strong growth given what's happened out of Washington. When you listen to what corporations have been saying up until this point, they're very much sitting on their hands, right? They're not investing a whole bunch in their business. They're not hiring a whole bunch of people. What we're trying to do is walk through a very foggy forest. We have a sense of where some of the trees are, but we don't have a great sense of whether we're veering off of the path.
So here's the latest this morning. Southwest and Pepsi joining a growing list of companies trimming their profit forecast for the year as uncertainty around Trump's trade policy continues to weigh on sentiment. Jonas Prising, the CEO of Manpowergroup, an employment services firm, joins us now for more. Jonas, good to see you, sir. Thanks for dropping by.
Thanks for having me.
You've got a decent read on the C-suite. Walk us through confidence levels now and how they compare to the start of the year.
Well, they are all reflecting this sentiment of uncertainty on where this is all going. And so they're holding on. They're adopting a wait-and-see approach as it relates to hiring. And, we can really start to see, that they're being very cautious in how they bring people in. They're very focused on specialist skills. They're not hiring broadly anymore. And this is really the stance that they're taking at this point.
This is what the Beige Book reported yesterday, that there's a lot of wait and see in the C-suite when it comes to hiring. They said there were scattered reports of firms beginning to lay people off. I'm just wondering if the hangover from the post-pandemic era of wanting to hoard employees still stands or whether that's fading.
It is still standing at this point. Hiring is highly dependent on employer confidence. But what we've seen, and it's really been an anomaly if we look at the U.S. labor market compared to the European labor markets or other labor markets, we've held on to much more labor than other parts of the world, given where they're sitting in the economic cycle. So employers are still very intent on keeping the talent that they think they will need when the economy starts to move at a faster pace. But that can change depending on the situation pretty quickly in the U.S.
We were talking earlier about how it's almost like the genie's been let out of the bottle, but we can't see how big it is, and we can't see what it looks like, and we can't see when it's going to go back in. There are all these cargo ships from China that haven't gone out and aren't going to hit U.S. shores, and all those truckers and shippers are going to not necessarily have anything to do. Are you expecting or hearing about a wave of potential layoffs to accommodate that lack of activity, particularly in that leading sector?
I'd say that most employers are really thinking that this is a situation we have caused through a trade policy that came on very quickly and very drastically across the board. They hope this is a negotiation tactic and this will resolve itself and that they can proceed, with a greater certainty going forward. Should that not happen, I think we can expect the U.S. labor market to react, as it's always done in the past, in a very rapid and dynamic way to a changing circumstance.
Who is more hit when it comes to the tariffs? Because I know you have such a large market in Europe as well and in France. The tariff rate that now the United States has on Europe, they're in the middle of negotiations. Who can withstand that better, the Europeans or Americans when it comes to hiring?
Well, the impact on hiring is not really discernible yet. Because of the pauses, most companies are also adopting a wait-and-see attitude in Europe. They're being very cautious about their hiring, but they also believe that this is a negotiation that the U.S. wants to entertain and arrive at maybe a lower level of tariffs that they can manage and they can adjust to. So we're not seeing any major moves by any employers in Europe either at this point.
So I guess I'm trying to understand is it worse in the United States at this moment, though, or is it worse in Europe? Who's more nervous?
Europe is more nervous, no question about that, as many parts of Asia. The world is holding its breath, waiting for the U.S. to sort of indicate where it wants to end up. And I think as I speak with companies and policymakers also across the world, the clarity of where we eventually want to end up isn't there. So there are ongoing negotiations, lots of talks going on, but the clarity of, no, the U.S. wants to arrive here to achieve this aim with the tariffs is not clear. And that means they all adopt a wait-and-see approach in terms of hiring. And we've seen labor markets cool in the U.S., we've seen labor markets cool across Europe, and right now we're in a wait-and-see period. That can change, both moving back to a better trajectory or down, depending on the outcome of the discussions.
Starting points matter. In comparison to the United States, who is in the best position right now going into this? Where do you see the most resilience, corporate America or across Europe?
Corporate America is really, in a stronger position based on the strength of the U.S. economy over a number of years. We've had a great labor market for a long time, a strong economy, albeit both of them cooling at this point. Europe has been struggling. PMI has been below 50 for over 3 years in European manufacturing. Germany, the engine of growth, has been struggling and been in recession for 3 years. So clearly, Europe is very eager to get this resolved and see some resolution so that the European economy can start to move forward again.
The engine of growth has had no growth. The German central bank governor just told Lisa just yesterday we could see that economy tipping into recession in 2025.
Yeah, and you add to that this difficulty of a stronger euro, which, by the way, it doesn't seem like they're very excited about being the reserve currency. If you talk about the U.S. potentially losing their status, it goes to this question, how much do European companies essentially act as U.S. companies and have such exposure, but except with the euro exposure, meaning that they're going to have reduced earnings? It's a difficult scenario right now at a time where potentially they are more exposed.
They've been looking to increase that exposure as well. Jonas, it's good to see you, sir. Appreciate your time. Thank you. Some insight into the C-suite, not just in corporate America, but worldwide. That was Jonas Prising there of Manpowergroup, the CEO. If you are just joining us, welcome to the programme. Equities doing better, well off session lows and just turning positive on the S&P 500 just moments ago. In the bond market, yields edging lower for a third consecutive session. Some welcome news coming from the bond market for those of you that are still long this stock market. Up next on the programme, the second hour of Bloomberg Surveillance. Live from Washington, we'll be catching up with Mike Wilson of Morgan Stanley, the South Africa Central Bank Governor Lesetja Kganyago, and we'll speak to the Eurogroup President Paschal, Donohoe, as well as the ECB Chief Economist, Philip Lane. Live from Washington this morning. Good morning. The second hour of Bloomberg Surveillance. Up next.
The Trump administration, we knew this, was going to mean a higher volatility asset market.
The challenge that we have now is we've seen a valuation adjustment as a result of the policy uncertainty.
When we're thinking about the investment implications, we take a sort of defensive rebalancing against all of this.
When you listen to what corporations have been saying up until this point, they're very much sitting on their hands.
Even though we've lowered our target, color us constructive.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Equity futures recovering and turning positive in the last 20 minutes or so. On the S&P, up by not even 0.1%. A revision, this time from Deutsche Bank, 61.50 on the S&P. That's their year-end price target. That's down from 7K on the S&P 500. We've seen pressure on the equity market, pressure on the bond market. We ease in that bond market. Yields are lower for 3 consecutive days. We're down by 3 basis points on a 10-year, 4.3519. The bond vigilantes have spoken. Now corporate America gets its turn. And you're seeing this word pop up across the board through earnings season. Uncertainty from Southwest, from Alaska Airlines, from Pepsi, from Chipotle. It's uncertain out there. We know that. We're hearing it on repeat. I think the biggest thing that took place this week was corporate America sitting down with the President of the United States, Home Depot, Target, Walmart, telling him that prices are about to go up, shelves are about to empty, and Lisa, that could happen within weeks.
Yeah, and you mentioned the retailers. You also mentioned the airlines. American Air also just withdrawing their guidance. So this building on this sense that they have no visibility. Tariffs have been cited in 90% of the calls so far in the S&P 500 earnings season. We have seen recession mentioned 44% of the time in these calls, given the fact that we only saw about 3% in the last quarter. This is a significant shift. Suddenly, how much is this the ultimate check on what President Trump plans to do, and then how consistent can the rock back be if there is still a lot of disagreement?
A source called me last night, very close to the Trump administration, said 2 key developments this week. One, the Besant ascent, as Neil Dutta would call it, and then this meeting you're talking about. The retailers of top American companies that are selling goods to everyday Americans coming in and painting almost an apocalyptic future under the current tariff policy, which is the shelves are going to be empty and prices are going to be higher. At the same time, Reuters Ipsos yesterday came out with a poll, found 37% of Americans only approve of Trump's handling of the economy right now. That's the lowest he's seen. 37% approve of what he's doing right now. The president that came in said, I'm going to bring groceries and everyday goods down. That meeting, I think, shook him and the administration.
Has it led to a bit of backtracking from the President of the United States? It certainly led to 2 days of powerful gains on the S&P 500. Over that period, up by more than 4%. And this morning, just about stable on the session. Coming up this hour, Mike Wilson of Morgan Stanley following big back-to-back gains. Lesetja Kganyago of the South African Reserve Bank on the changing trade landscape. And the ECB chief economist, Philip Lane, on diverging monetary policy. We begin this hour with stocks off session lows following mixed signals on trade talks. With the latest on trade negotiations, Bloomberg's Tyler Kendall joins us now from the White House. Tyler, corporate America seems to be having its voice. Do you think it's making a difference in Washington this week?
Yeah. Oh, yeah. Hey, John, good morning. I mean, definitely at this point, as it appears that this administration is taking in the input from retailers, consumers, and the markets alike as it starts to tone down its rhetoric when it comes to talking about progress on these trade deals. But still, there is just so much mixed signals coming out of this White House, including new this morning that China is now demanding that the U.S. remove all unilateral tariffs, something that the Treasury Secretary Scott Bessent told reporters yesterday is just not on the table. China's Commerce Ministry going on to deny that there are any talks currently happening between Washington and Beijing, saying that any reports of developments are considered to be groundless at this point. At the same time, President Trump, when he was asked if he's actively involved in negotiations with Beijing, he ultimately said that everything is active. And we should point out there is a Chinese delegation here in Washington for the IMF spring meeting. So what happens next here really does remain to be seen, as President Trump indicates he thinks that 145% levy on Chinese goods is very high and amounts to a trade embargo, but at the same time says that if a deal isn't reached, that would be okay because the U.S. is prepared to set what he called a, quote, fair price. He then went on to suggest that this White House is preparing to release revised tariff rates for countries, including China, in the next 2 weeks. Now, we started this conversation talking about how potentially the private sector is having some impacts here, and we know that the administration is negotiating with a few different private sector interests, including the automakers. John, there is new reporting from Bloomberg News that the auto sector could potentially be getting some reprieves. There's a few proposals on the table, including fully exempting USMCA-compliant auto parts. Remains to be seen if that actually comes to fruition, but it would be a big win for the auto industry if true.
Tyler, thank you. Tyler Kendall here in Washington, outside of the White House. Here's the view from Wall Street. Mike Wilson of Morgan Stanley writing, the risk of a recession has increased, and this type of economic slowdown has not yet been fully priced into the index. As long as this risk stays elevated, we must remain balanced. Mike joins us now for more. Mike, good morning and welcome back to the programme, sir. Always good to get your thoughts on things. The Wall Street Journal reporting just yesterday that maybe we land with say, like 10% across the board tariffs and then 50 to 60% on China. Mike, if we end up there and consensus is building around that view, would that be enough for earnings revisions to reverse course?
Well, good morning, John. Yeah, I think we've done a lot of damage on revisions, okay? And this is something we've been talking about for quite a while. This revision process started, well over 6 months ago and even really last year. And for some of the more economically sensitive parts of the market, I wouldn't say that process is fully complete in a recession. But if we don't have a recession, then that process is probably pretty close to being complete under the terms that you sort of laid out. And also, I think what really matters is the implementation time. Companies need time to adjust, supply chains, get their pricing in order, make sure inventories are in the right place. I think the biggest, issue with these tariffs is not so much the level, but the speed in which they're being levied. And I think that's why the 90-day, delay was put in, because companies just can't adjust that quickly. So, look, we're in the uncertain phase of this, obviously. We've been pretty specific about our targets. The 5,000 to 5,500 range seems to be working pretty well for now. What I'm looking for is something to get us to break out to the upside or the downside. Earnings revisions is a big one. I don't really envision earnings revision, Brett, turning up in a significant way until the third quarter, probably at the earliest. But of course, if the Fed were to get more dovish, or we were to see an actual deal signed of some kind with China or an agreement, I think both of those could lead to more upside. On the other side, of course, a recession risk is real, as we mentioned. It's probably 40% plus. That would take us below the low end of the range. And of course, the bond market now is not really behaving the way that it normally does in a slowdown. And I think that's the other wild card that's kind of hard to predict. If term premium goes up and the back end kind of blows out, that would also take us below that 5,000 level.
So, Mike, what do companies do in the meantime? We had a conversation with Citi just yesterday, and Citi suggested that they'll be pulling back on CapEx, makes sense, but they'll be leaning harder into capital return programs like buybacks, Mike. Where are you and the team on that point?
Well, I think it's company by company. Clearly, if there's coming a period of uncertainty, companies want to conserve cash. So I'm not sure I agree with the comment that we're going to see buybacks accelerate. For the companies where the value is there, where prices have come down, maybe that's the case. But usually in these times of uncertainty, companies conserve cash, whether it's for CapEx or for buybacks. And I just, that's going to persist. And companies are really good at adjusting. Particularly American companies. I think your prior guest was talking about U.S. companies versus the rest of the world. I would still bet on, Fortress America from a corporation standpoint, that they're going to be able to kind of mitigate and manage this, at least the larger cap quality companies for sure. So, this process is ongoing. And just remember, though, John, markets trade ahead of, the headlines. And that's why we can't get too bearish here either, because, markets have been thinking about this for quite a while. I think we were probably early, kind of make the call that the sequencing on policy would be growth negative. If I could figure that out 4 or 5 months ago, the market definitely was thinking about it too.
One thing the market might not have been looking at, Mike, was the potential loss of U.S. exceptionalism across a whole host of assets in a big, significant way. And that suddenly dollar-denominated assets were called into question as a ballast, particularly for international investors who are now facing a currency loss and an actual loss in equities. How much are you concerned about a structural shift, even small, even on the margins, away from U.S. allocations that could fundamentally and for a prolonged period change U.S. equity valuations?
Well, once again, markets have been doing this adjustment, for a while and very swiftly. So, we look at our data both for retail and institutional clients, and the adjustment process has kind of happened with or without any active decision. For example, given the move in both the U.S. dollar and asset prices, I would say that most globally invested investors have been rebalanced, okay, not by choice. And you can see that in the data. So I think a good part of that adjustment process has already happened. And now, of course, you asked the right question. Is this going to be a secular trend? I think the dollar weakness is absolutely a goal of this administration. And once again, let's talk about what a weaker dollar does to earnings. At least from a multinational standpoint, it's quite helpful. So if I look out 6 months and I look at where the dollar is today, I have to get incrementally more constructive on earnings growth potentially in the fourth quarter. And this is something that we've talked about for a while, which is I'm not willing yet to kind of throw in the towel on the good parts of the changes that are going on. In other words, these are front-end loaded changes that are growth negative and uncertainty. But if you look out 6 months or 12 months, some of the growth positive aspects of the policy changes could start to flow through. And one of those is a weaker dollar from an earnings standpoint.
Well, that might be helpful for U.S. companies. It's not helpful for the U.S. fiscal backdrop if it does lead to outflows from treasuries as well, especially given the support that other central banks are giving with rate cuts elsewhere. How much does that matter to you for this position of growth later this year if, say, the protest extends to the bond market in the U.S.?
Well, I think Lisa, you're on. I mean, you're right on. I mean, that's already started. I mean, that is probably the biggest question mark for not only global investors but U.S. investors is, the funding of the deficits, which is not a new phenomena, right? We've had excessive deficits now in the U.S. for years, and this is the big question: how is the U.S. government going to fund its deficits going forward? The bond market's going to extract a higher or better price to do that. Is that 4.50? Is that 5%? Is it 4.25? Can they get it back down there? We'll have to wait and see on that. But I mean, this is a work in process. I still think the government will be able to fund itself. I don't think the U.S. reserve currency is going the way of the graveyard. The weakness in the dollar, I think, is a trend that's in place. I don't think the U.S. is losing its reserve currency status. And so it will be funded. The question is price. And I believe that at 450 on a 10-year Treasury bond, that's equity unfriendly. We've talked about this for months. And the market continues to show its reaction above 450 on a 10-year as being negative for price earnings multiples. Below 450, it could be constructive. So this is the threshold. And I think the market is battling right around this zone. So let's just see how it goes here into the second half of the year.
Mike, is that the threshold for Wall Street and the White House?
I don't know about that. That's a good question. I mean, I think they're well aware of it. I think coming into this year, I mean, early on, I mean, both the Treasury Secretary and the President said we're not focused on the stock market, we're focused on the bond market. So they're definitely focused on some level. At 450, we've seen some jawboning, perhaps, to talk it back down. So I think 450 is an important level. But I think ultimately, they probably like to see it closer to 4 or even lower because that will then lead to other borrowing rates, particularly in the mortgage market.
Mike Wilson, not giving up on Fortress America. Mike, appreciate your time, sir. Thank you. Mike Wilson there of Morgan Stanley on the US equity market and on the bond market too. This morning, better news in the bond market again. 3 consecutive days of lower yields, edging lower across the curve. The 10-year this morning down about 3 basis points to 4.35. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahira Hackes. Hey, Yahira.
Hi, John. American Airlines reporting first quarter earnings that came in line with analyst estimates. But the big headline is it's withdrawing its full year guidance, joining a growing number of companies saying uncertainty about the economy is making it difficult to forecast how the year will play out. American said it will provide an update as the outlook becomes more clear. Shares are lower by 0.6%. And let's get a check on pharmaceutical giant Merck. Those shares are higher 1.4% after it posted a slight beat on earnings. It's also giving a glimpse into the tariff impact, saying it expects to lose $200 million in 2025 amid the U.S.-China trade war. But that doesn't take into account the possibility that President Trump may still impose levies on pharmaceutical imports to the U.S. And Elon Musk's Neuralink is planning to raise about $500 million at a pre-money valuation of $8.5 billion. Sources telling Bloomberg the company has already begun preliminary discussions with potential investors, but terms have yet to be finalized. Neuralink was previously valued at $3.5 billion as of November 2023. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. I'm next on the program, reshaping global trade.
Remember, there's no tariff when they build their plant here. The higher the tariffs go, the more likely it is they come in and build a plant.
Up next on the program, we'll catch up with the South African Reserve Bank Governor, Lesetja Kganyago. Live from Washington, D.C. this morning. Good morning. Equity futures on the S&P 500 doing okay so far this morning, recovering from losses. On the screen at the moment, the S&P 500 just about negative by 0.2%, 61.50. The new year-end price target over at Deutsche Bank. The base case remains for a significant rally on a credible relent on trade policy. Still looking for some upside, but that upside has been reduced. They were looking for 7K on the S&P 500 at the start of the year, and the start of the year feels like a long time ago. Under surveillance this morning, reshaping global trade.
We're going to have great deals. And by the way, if we don't have a deal with a company or a country, we're going to set the tariff. Remember, there's no tariff when they build their plant here. The higher the tariffs go, the more likely it is they come in and build a plant. You know, I mean, if it's 25%, that's fine. If it's 50%, you'll get more plants. 75, you get more. At 100, you get more than that.
So here's the latest this morning. President Donald Trump continuing to pitch America as a manufacturing destination while softening his tone with China to de-escalate global trade tension. The Federal Reserve still stuck between a rock and a hard place, facing down upside risk to inflation and downside risk to growth. Joining us now, a man who knows something about that, the South African Reserve Bank Governor, Lesetja Kganyago. Governor, it's good to see you, sir.
Good to see you.
It's the classic central banker's dilemma that you and I have discussed for years, and now Chairman Powell has to confront it. We've had this conversation a few times now, where developed markets, developed countries have to face what EM countries have faced repeatedly over decades. What's your advice for some of these people? Some of these people that have to confront some of the things that you have to think about all the time?
Well, I'm not sure that I can provide much advice to Jay Powell. He knows quite a lot about the U.S. economy. I think that for a long time, this is a dilemma that I would call the central banker's worst nightmare. And we had to confront with that a number of times. And when you are faced with that dilemma where growth is slowing down or even contracting and you have got rising inflation, you can stomach the trade-off for a bit, but at some point a central bank with a price stability mandate is going to have to show its hand and rein in rising inflation, failing which you will have a situation where you lose your credibility because inflation expectations might de-anchor. At the moment, for many inflation-targeting central banks, it looks like inflation expectations are still well anchored.
For central bankers outside of the United States, they have described this event as potentially a disinflationary shock. And I just wonder from your perspective whether a weaker dollar, whether what we've seen in energy, whether what we've seen in trade opens the door a little bit more for you to think about reducing constraints, reducing interest rates.
Well, the focus is always on what the inflation outlook is and what the growth outlook is. The most recent inflation print that we have had in South Africa is 2.7, which is the lowest since we had in June 2020. We still think that the next print might still have a two handle to it. But the environment is uncertain. What we had faced had been, in our case, that we import oil. The oil price had come down. Although the South African rand has depreciated, what we had found had been that the decline in the oil price more than made up for the depreciation of the currency. And what we had seen had been that the big driver of the disinflation process over the past 2 months had actually been the oil price.
How much are you confident that the South African economy has insulated itself enough from the United States to withstand any potential upheaval when it comes to trade relations? We've heard a lot of rhetoric, pretty heated rhetoric coming out of the White House directed at South Africa, as well as potentially market disruptions on the heels of that.
We're not insulated at all. We are a small open economy. We do have credible policies to help us absorb the shock, but that is in no way meaning that we are insulated. Why is it so? the U.S. Accounts for about 8% of South Africa's exports, and we do run a small trade surplus with the United States in as far as goods are concerned. But the U.S. is running a significant surplus with South Africa with respect to services, and it just makes sense. This is a big economy with a huge services sector, and services are a big export for the U.S., and that is what we are seeing in the South African context too. We had benefited from the GSP and from AGOA, and what the tariffs that were announced on the 2nd of April would actually mean is that would be the end of AGOA. But for us, it's also that it was not just access to the U.S. market. We have got just over 600 U.S. companies in South Africa. Those companies are investing in South Africa, and part of it is their drive into the African continent. But we have also benefited from a relationship with the U.S. because we are not just exporting commodities to the U.S., we are exporting manufactured goods into the U.S., which is driven in the main by American and European companies.
So there's that aspect of just integration. There's also an aspect of how vulnerable your policy setting is to volatility in benchmark treasury yields, given some of the disruption that you've seen in government bond markets. How much does that influence how you position and potentially threaten financial stability for you?
Financial stability is at the moment not under threat. The core of the South African financial system is actually resilient. We had experienced the shocks before, whether it was COVID, whether it was the great financial crisis, whether it was the debt crisis of 1998. We had been able to withstand that, and it just talks to the quality of regulation and supervision in South Africa and the fact that we have got such a resilient financial sector. With respect to the U.S. treasuries and their impact on South Africa, there's just over an 80% correlation between the U.S. 10-year treasury and the 10-year South African government bonds. And so to the extent that there is volatility in the U.S. treasury market, we actually feel that volatility. What the recent moves have done had been that it had slowed down the disinflation process, and some people are actually talking of inflation in the U.S. actually starting to rise, and that would mean that global financing conditions could remain tight for longer for small opening economies like ours. So it's going to be a fairly challenging environment, but it does not pose a threat to financial stability at this stage.
Did you expect 2025 to be this much fun?
The life of central banking is never boring.
Governor, it's good to see you, as always, my friend. Thanks for catching up with us. The South African Reserve Bank Governor, Lesetja Kganyago there, on what it means to be an EM central banker and the lessons may be for some DM central bankers out there confronting some upside risk to inflation and downside risk to growth. Up next on the programme, we'll catch up with the Eurogroup President, Paschal Donohoe. You're watching Bloomberg Surveillance. Two hours away from the opening bell, equity futures on the S&P slightly softer, but no drama. We're down 0.25% on the S&P 500, following two big days of gains. On the S&P 500, over the last 48 hours, a gain of more than 4 percentage points. With some morning movers this morning, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Just sorting through some of the earnings we got in the past 30 minutes. To be honest, not lots of drama for American Air, despite the fact that they have pulled their full-year guidance. Shares aren't even down 1%, just 0.75%, following in the footsteps of Delta, of Southwest, saying that they're not going to give an update for where they see the full year going until things become much more clear. It's anyone's guess as to when exactly that will happen, but they also pointed to domestic sales for leisure that have already started to tail off. So that's American Air. We also heard from P&G, the consumer company. Similar story with them. They didn't withdraw guidance, but they cut it for sales, seeing it somewhere in 2%. At one point, it was as high as 5% growth for the year. Again, like so many companies, pointing to the macro uncertainty and what that means for consumers and their very own prices. Shares falling 1.4%. Now, I've had company after company I've been talking about saying, look how bad things are because of the macro environment. Bristol-Myers, the complete opposite. A beat and a raise, specifically because of the macro environment. Yes, their older drugs did better, but they saw a huge benefit from a weaker dollar, that FX channel, allowing them to beat on sales for this quarter. Those shares up more than 1%, John.
Danny, thank you. Three of the names to watch in the pre-market. On our radar this morning, President Donald Trump signaling the U.S. is still looking to strike a deal with China. The Treasury Secretary Scott Bessent adding Trump hasn't offered to take down levies on the country. China now demanding the U.S. revoke all unilateral tariffs.
Yeah, so to me, raises a question. Are they actually talking? Have they talked? Are they going to have some sort of conversation this week with all of the meetings going on in Washington, D.C.? It shows how long this path can be and how messy it can be before we actually get resolution.
Well, I remember in February when the Treasury Secretary joined us around the table, he talked about the fact the first time he was going to see one of his Chinese counterparts was going to be this week at the IMF spring meeting. So every time I get an alert from the Treasury Department and a readout of who we met, I'm like, oh, was this the Chinese meeting? It hasn't happened yet. Will it happen? I think that's a key feature of this week.
The meeting between retailers and the president has happened. Corporate America using its voice very loudly this week and warning of more uncertainty what it could mean for the outlook for profits. U.S. Airlines signaling more uncertainty. American Airlines withdrawing full-year guidance and Southwest trimming growth expectations, adding that flying capacity will be reduced in the second half of the year to accommodate a lower demand environment. Southwest, Lisa, down by 4%.
This, to me, shows the playbook, at least in the margins for a lot of corporations. Reduce capacity, keep prices the same. Try to offset potentially some of the tariffs or some of the pricing pressures with even increasing prices, but just less product, less flights, fewer flights. That, to me, highlights what you did here in the Beige Book. And I keep referencing it because I actually thought it was fascinating this week about how much companies are starting to look at raising prices because there is no other way for them to really continue.
Getting lots of earnings. You'll get more earnings after the closing bell. We'll hear from Alphabet. Investors around the world watching those closely for cloud growth and progress in AI. Google also facing regulatory pressures after federal judges ruled it's maintaining illegal monopolies in search and ad technology. If you're looking at equity markets this morning, equities just slightly softer, losing some steam following mixed messaging on trade talks with China. On the latest trade talks, I'm pleased to say that joining us around the table here in Washington is Paschal Donohoe, the Eurogroup President and Irish Finance Minister. Minister, it's good to see you, sir.
Good morning. How are you all?
I'm fantastic and all the better to see you. So let's talk about these trade negotiations. Have you got a better sense of what the ask is from the White House?
Well, so they have indicated publicly what they are looking for and what they have made the case for. And what we want to do within the European Union is move that into a negotiation that we hope can take place across the coming weeks and months that can lead to a mutually beneficial outcome for both sides of the Atlantic and avoid the very uncertainty and risks that you've all just discussed really gathering steam and hurting jobs and growth for all of us.
Is it a realistic time frame to have those negotiations the next few months?
Yes, I believe it is. From our side of the table, through the work that the Commission will do, our Commissioner for Trade, Commissioner Šefčovič, will be putting our best foot forward. We want to make the case for the benefits of trade and make the case for protecting an economic relationship between the EU and US that's worth billions of euro per day. And that's what we will be aiming to do.
Will you make that case this week along the sidelines of the IMF World Bank meetings?
I've made it in many different fora and I'll continue to make it here. I believe and acknowledge that there are issues in relation to trade imbalances, what it does for living standards, that we all have to be cognizant of, that we all have to reflect and then act upon. But I'll also be making the case that trade is good for jobs, good for economic growth, and good for responding back to the needs that our societies have. And that's the case I and my fellow finance ministers in Europe have made regularly, and these meetings gives us the opportunity to emphasise that.
Kevin Hassett, the president's NEC director, yesterday was on Fox News talking about the fact that 18 countries are coming in with deals they're pitching. Jameson Greer, the USTR ambassador, has about 14 meetings this week alone dedicated to trade. Do you and your colleagues in Europe have a sense of what the U.S. is asking for in these meetings?
Well, I think in fairness to President Trump and his administration, I mean, they have been outlining generally what they're looking for, and then country by country or region by region, they've been outlining particular views regarding what they want trade agreements to look like. Given the importance of these negotiations, I'm not going to comment publicly regarding the detail of what I believe should be in them.
Can you tell us who you're meeting with?
I have been in meetings with Secretary Besant, but all of the negotiations formally will take place from the Commission that will be representing us with the representatives of President Trump. And I expect those meetings and that engagement will gather momentum in the time ahead.
How much unity is there between the European finance ministers?
A very high level of unity. All finance ministers met in Warsaw there only a number of weeks ago. We'll be meeting again in Luxembourg now very, very shortly. The areas that we have complete alignment on are supporting the Commission, responding back in a way that is proportionate and firm, but creates an environment within which negotiations can take place, as opposed to getting us to a place where those negotiations become even harder. And also looking at how the European Union can play a role in many other parts of the world in continuing to promote trade.
That's the issue that I actually wanted to hone in on. How much has the discussion centered around potentially increasing trade ties outside of the U.S., looking for alternatives, maybe even the euro as a reserve currency, discussing ways to adapt to a brave new world?
So indeed, but I should make clear at the very start, we don't see this as an either-or scenario. Let me just emphasise again the value we place on the economic relationship with the United States, and it's one we want to work very hard to make the case for. But undoubtedly, because of the big debate and shifts that we can see taking place now regarding global trade policy, the European Union as a trade-intensive trading bloc that believes in the benefits of trade, want to look at trading relationships that we have elsewhere and see how we can deepen them, but also inside the European Union, look at the further steps that we need to take to promote the trade that we have with each other.
Do you want to deepen the trade relationship that the European Union has with China?
So we, of course, place great value on that relationship with China. The framework that we have had for managing and developing that relationship in recent years has been very clear, and I believe will remain unchanged. We see many areas with China in which we want to be partners with them, we want to work with them on. I'd highlight, for example, climate change, that the EU continues to place a very, very high value on. And then there are other areas in which we acknowledge we compete with each other. And we want to look at how we can get the balance right in that relationship with China in the time ahead.
How sustainable do you think that is? Can you maintain a relationship with both China and the United States simultaneously with the leadership that's currently in the White House?
But I look at the debates that are taking place here in America, and I think, and I can see a recognition of the value of the trade that takes place between China and America, albeit an obvious political focus on looking at how we can restructure and change. So in the world that we're in at the moment, I think it is important that we look at how we maintain trading relationships with each other. But of course, I acknowledge in the environment we're in, that's more complex at the moment and will require a lot of work. But that is the role of finance ministers and the role of our Commission, and we'll work with each other to do that.
Let's talk about your role as the finance minister in Ireland. Ireland, as you know, heavily leveraged to access in the United States. I'm not sure if our audience quite recognise just to what extent. I was unaware that Pepsi made the concentrate over in Cork and has done for decades for the drinks that are sold worldwide. Could you help me understand what the corporations that are present in Ireland right now are telling you and whether they are developing plans to move away?
So the corporations that we've had in Ireland have been present in Ireland for many, many decades. Many of the companies that we have been present in Ireland since the 1960s and 1970s. The broad messages that they are giving to us is they continue to place a value on global supply chains. They continue to see Ireland as being a competitive place for those global supply chains to play a role in, because of our role in the European Union, because of our relationship with America, and because of the competitive environment that we have. Yes, indeed, companies are now looking at where they locate investment, but it's always been like that. That's always been the case. And what we have to do now is to continue to ensure that if companies want to be present in Europe, which they do, that Ireland is a competitive place within which they can be located, while at the same time engaging with our colleagues here in the US about the issues that they are putting a lot of focus on.
We anecdotally have heard about a couple of companies, and Tesla is the poster child of that have seen declines in sales, in part because of their association with the United States, out of protest maybe to some of the U.S. policies that people disagree with. Do you hear and see something similar in Ireland with U.S. companies falling out of favor in a more material way?
No. The American companies that are present in Ireland, many of them are very large employers and are well known to our economy and to our consumers. And I, at the moment, see little evidence of that kind of sentiment within Ireland. We all really appreciate that if global trade begins to destabilise and begins to get to a difficult place, all that we have to lose. And really, it's the responsibility now of the Irish government and all other governments who feel like this to see how we can deal with these issues in a responsible way. But I don't see that kind of shift in consumer sentiment at the moment across our country.
We know President Trump hates trade surpluses, and Ireland's trade surplus is mostly driven by manufacturing of pharmaceutical goods sent over to the United States. We're still waiting for the president to drop these sectoral tariffs on the pharmaceutical sector. Are you concerned at pharmaceutical manufacturers potentially facing a very high tariff that they might move from, say, Cork County over to the United States?
So we recognise the challenge that is there. But in relation to the life science and medicine sector in Ireland, many of the products, though I accept not all, that are brought back to the US in turn require further work, further economic activity to take place on them in the US. And many of the companies that you're referring to also have very, very valuable businesses within Europe and elsewhere in the world, which they use Ireland to ship from. And these companies wouldn't be present in Ireland in the first place for so long if we didn't have the skill and expertise that allows this work to take place. We'll be making the case for that. We'll be making the case for how that is good for those companies as well, and therefore indirectly for the American economy. But we recognise, as these companies do, that a big debate is underway regarding where their activity is located and the need for that to be done in a balanced way.
Minister, we know you've got a busy morning ahead of you, so thanks for making some time for us.
Thank you very much, and have a good morning.
Thank you very much. You as well. The Minister of Finance in Ireland there, Paschal Donohoe, the Eurogroup President as well. Let's give an update on stories elsewhere this morning in your Bloomberg brief. Here's Yahara Hackett. Say, Yahara.
Hi, John. It's a busy earnings day, and Comcast is the latest. Shares are lower 3.5% in the pre-market after the communications giant missed estimates on its internet and cable subscriptions. The company lost nearly 200,000 broadband customers and over 420,000 cable subscribers. However, subscriptions for its streaming service Peacock did jump 21% from a year ago. Meanwhile, Harvard University is indicating it wants to move quickly in its legal fight with the Trump administration. The school telling a federal judge it won't ask for a temporary order to block the government's funding freeze. Instead, it's planning to seek a quick judgment on its central claim that the administration is threatening its independence and free speech. And Tesla is expanding testing of its rideshare app to the company's employees in Austin and the San Francisco Bay Area. The EV maker said it's already completed over 1,500 supervised self-driving trips spanning 15,000 miles. Tesla is aiming to officially launch its robo-taxi service this June. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Things are pretty fluid. Things can change. Just to bring you the latest reporting, this from ABC, that the Trump administration is considering possible exemptions for some Chinese auto parts, according to their reporting so far this morning. More on that a little bit later. Up next on the programme, Europe's wake-up call.
We are in a stagnating situation. So stagnation is the picture for this year, maybe recession. Europe has to stand together in these complicated times. Cooperation is key in these days.
Up next on the programme, the ECB chief economist, Philip Lane, live from Washington, D.C. this morning. Good morning. Two days of gains on the S&P, taking a little bit of a nibble out of that rally this morning. We're negative by 0.3%. No real drama, though. On the Nasdaq, we're down about 1/3 also. Under surveillance this morning, Europe's wake-up call.
We are in a stagnating situation. So stagnation is the picture for this year, maybe recession. Europe has to stand together in these complicated times. I will use these days here in Washington, D.C. to get a better understanding, to convince the partners here that cooperation is key in these days.
So here's the latest this morning. The ECB warning tariffs may be more disinflationary than inflationary for Europe. This after President Trump said he's confident of reaching a trade deal with the EU. Joining us around the table here in our studio in Washington, D.C., the chief economist of the European Central Bank, Philip Lane. Philip, it's good to see you, sir.
Good morning. Nice
Thanks for being with us here in Washington. So the Governing Council meeting, I imagine, was very different this time around than a number of months ago. When you walked into that room and presented changes to the economy, what did you tell the team?
Sure. I mean, I think it was a gear change for several reasons. So, of course, our core business has been to try and get inflation back down from a high number to our target. So I think there was a milestone in this meeting in the sense of the most recent data had come in quite low. We'd been waiting for services inflation to kind of drop, and it has been dropping. And then we had surveys showing that basically the wage dynamic this year and in 26 is lower than we expected. So basically, if you like, if you clear the table about the historic issue, are we safely bringing inflation back to target? I think it's not entirely settled, but a lot of it is settled. So the gear change was, of course, now we have new things to talk about. And really, since all the way back to last summer, trade policy uncertainty has been part of what we've had to talk about. But we still have trade policy uncertainty, but we also have trade policy news. Lots has happened. And then the other element of what we've seen is, of course, and that happened, by the way, like a day or two before our March meeting, was the German breakthrough on fiscal policy.
Yep.
So we already had that, if you like, in the early incarnation at the March meeting. We know more now, but it's still, in terms of what the other European countries are going to do, it's something that's still in discussion. So what I would say, if you put all of that together, and I think you're probably hearing this from various colleagues and other people this week, is if I take a longer term perspective, and the IMF in their publications this week, a lot of the data go out to 2030. If I take a 2030 perspective, I think there's a lot of grounds to have a renewed optimism that essentially with more fiscal support, the credibility of delivering our 2% target on a kind of long-term basis is stronger. The case for the European economy to be more resilient, to grow from a domestic source, not just from running a big export machine, is more credible. But of course, we have to navigate from where we are now, where, as you said in your intro, immediately in the short term, the way it's playing out, with euro appreciation, with a big drop in energy prices, the disinflationary forces are there. But I would say maybe I wouldn't load it all onto trade policy.
Sure.
Because what we also see now is a portfolio shift. So there's a clear portfolio shift going on, which is, I think, the way you can reconcile euro appreciation in the middle of this trade discussion.
As you know, Philip, that sort of begs the question why you don't act more aggressively. Does that give you the space to act more preemptively?
Well, I think a very important narrative we had last week, and it was repeated throughout the monetary policy statement, was resilience. What we're seeing is the European economy growing. 2 years ago, it was kind of more stagnating. So we said the European economy is going to recover. We saw, modest but still market recovery last year is around 0.9. We have 0.9 written down in March for this year. And that's basically because with incomes going up, consumption should recover. With our monetary policy and the general improvement of the economy, investment should recover with more government support. So all the domestic engines are there. So what you have to think about is all of that, if you like, is saying the economies should be growing, even marking down some trade negative. And this is why we're not in a situation where we see some dramatic change in the external environment or in price pressures and so on. So steady is okay, I think.
Hold on a second. Are you saying that what we've seen with respect to U.S. policy and the uncertainty isn't increasing the chance of recession materially for the euro region?
Well, I mean, I think our overriding theme, of course, is uncertainty, and let's not get ahead of ourselves in terms of being too sure about any path for the economy. But I think the message is, but it's not me dreaming it up. If you look at the external watchers, if you look at the IMF, it's fairly modest markdowns on the growth rate for the European economy. The US, of course, has a major trade policy issue with the world. We have a trade policy issue with the US. The US is an important trading partner, but it's not our only trading partner. So directionally, it is a markdown. There is a markdown, but it's important to say it's a markdown from a growth rate around 0.9 to a little bit less. Let's see in the coming weeks how much less. And I think if you look at the surveys this week, the surveys have elements of people being concerned, but they also have elements saying right now we're busy. Manufacturing is a bit busier than it was. That could be a little bit of front-running of tariffs, for sure. But it's also, remember, the recovery narrative. Europe has been stagnating. The American economy has grown quickly. So if you like, in terms of if there was room for the American economy to decelerate and then trade policy is adding to that, what I'm saying to you is essentially the baseline for Europe was to grow a bit more quickly. And so the resilience is there. You can take a trade hit without going to using that word, which that you mentioned.
You mentioned, of course, that Europe has more trading partners than the United States. How concerned are you that if the walls keep going up in the United States, China will have to just dump somewhere, and it's going to be on the continent?
So I think directionally, an element of that must be expected. But I think China fully understands that. If you listen to their policy announcements, their focus is on improving domestic demand. So in terms of the reorientation from the US, I would allocate a fair amount to domestic demand, some amount to around the world. But I think also China understands it's a large economy and a bit of restraint in exporting may make sense.
Philip, I've got 20 seconds left. I just wanted to jump in. Ollie Rehn was busy this morning, your governing council partner, and he made the point that we should be open to larger interest rate cuts. Is that a position that you and the team agree with?
Philosophically, we don't pre-commit to any rate path.
Of course.
And so this is why, again, it's important, and I think the governing council, tries hard to maintain this. It is, you can express that in different ways. And in particular, there's no reason to say we're always going to do the default of 25. Philosophically, I agree with that.
Okay.
But what I said to you earlier on is right now, the growth performance, I'm sure to be marked down. But it's still a growing economy. We have inflation, I think, to the downside. But we don't need to be too dramatic about it.
Philip Lane, the chief economist of the ECB.
If these policies and these tariffs stay in place, then we will have a recession with a very high probability.
The president only gets out of this if he, in a credible way, commits to self-limit.
I don't know that it's too late to pull out of that swoon, but we've been getting pretty close.
The sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data.
I'm optimistic in the longer term about the U.S. economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning, good morning to you all from Washington, D.C. The IMF World Bank spring meetings well underway. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 slightly softer following two really good days of gains on the S&P. 2 days of gains totaling more than 4% on the benchmark in the US. Equity futures on the Nasdaq down by about 0.1% this morning. No real drama and no drama in the bond market. That is welcome news. In the bond market this morning, yields lower for a third consecutive session. The 10-year down by 4 basis points. 4.34. The bond market's had its moment. The bond vigilantes were shouting and screaming over the past few weeks. This week, corporate America is having its moment. We've said repeatedly on this program, potentially the most important meeting that took place this week, not at the IMF, not at the World Bank, not between ministers, but between the President of the United States and the biggest retailers in this country, Home Depot, Walmart, Target, making a case that in the next few weeks we could see higher prices and fewer goods.
The fact that he listened to it, the fact that A, he had an audience with these executives, and that B, he saw some sort of shift in tone, is sort of hope, giving more hope to markets that are only down some 5% now from April 2nd, Liberation Day, that maybe he will reverse course. It is difficult to put this away, though, given the uncertainty in markets and given the fact that ultimately companies still don't have a concrete sense of what they can expect ahead.
Corporate America is painting this dark picture of supply chain disruptions, higher prices, empty shelves, all going into back to school time. And then, of course, at the end of the year, the holidays and Christmas. And obviously that shook the president a bit. That is one key meeting I was told that was very important this week, beside the fact that Secretary Bessent has been more of the vocal individual part of the cabinet going out and talking about trade. It also comes at a time when I go back to this Reuters Ipsos poll released yesterday, the lowest marks the president has received since his first administration as well when it comes to his handling of the economy. He promised everyday Americans to bring prices down. And corporate America is saying we can do that, but not with these tariffs.
Based on the words so far this week, he appears to be responding to that. But based on the actions, no change just yet. We still have the tariffs we had last week and the week before on a range of countries, including China. What we've heard from the likes of the Wall Street Journal is that maybe those tariffs will be reduced by as much as half on some goods. What we heard from the Treasury Secretary is something that a lot of people were waiting for, that they won't do this unilaterally, something Reuters reported yesterday afternoon as well. The president is still going around and saying, though, if you don't come to the table, we will do things unilaterally. We'll decide the tariff.
Yeah, I don't know what he meant by that. Maybe there's a chance that he meant in the next few weeks they could see the rate go down just because of all he's hearing about from corporate America. I view the whole situation circular. The president promised on the campaign trail a 10% tariff wall around the United States, 60% on China. The Wall Street Journal is now reporting that they're thinking about just dropping it to where he promised it a year ago. The problem is we've had a ton of disruption in between.
You've made this point repeatedly, and consensus is starting to build around that view over the last few days. Equity futures right now in the S&P just a touch softer. We're down by 0.2%. Coming up this hour, Franklin Templeton CEO Jenny Johnson following back-to-back gains for equities. We'll catch up with Carlos Cuerpo, the Trade and Economy Minister of Spain, on a US-EU trade deal, and the Standard Chartered Chair José Viñals on the potential for lower levies on China. We begin this hour with stocks lower as investors await clarity on trade talks. Jenny Johnson, the CEO of Franklin Templeton, one of the world's largest investment managers, joins us now for more. Jenny, it's good to see you.
It's great to be here. Thanks for having me.
Things have changed a lot since we caught up with you in Davos, Switzerland. There's a lot of optimism. You remember it. Everyone was charged
US
up.
exceptionalism.
Bullish growth, lots of hiring, markets are great. Things have changed a lot. How have they changed for you?
Well, we talked about it at the time. I think that you have to think through kind of where the president is, right? He's come in with a plan, and he's been very clear, right? It's taxes, immigration, tariffs, government efficiency, and deregulation, right? And he has about a year and a half to get those things done before the midterms come in. And so, from the tariff standpoint, again, he's a deal maker. So when you are trying to make a deal, you need to show that you are in the position of strength, right? So a lot of this blistering is around, I'm in a position of strength and you're going to have to bow to my will. I think the challenge has been there are some unintended consequences of that. I was talking to somebody yesterday about Canadians. They're not upset about the tariffs. They're upset about the 51st state comment. And that Airbnbs in Rhode Island are down because the Canadians say, I'm not going to come visit the U.S. So those are the unintended consequences. The other piece of this is he needs the tax revenues identified in tariffs to help fund his tax cuts, which, by the way, are not tax cuts, really. They're extensions. And if we don't get that extension, there is a massive tax increase that happens, which really becomes an issue around the economy.
Can you describe how you and the team think the end game looks like? What do you think it looks like? Because some people have described the last few weeks as madness. Is there a method to it?
Yeah, so I think what we hope to see, right, you'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal, right? So if we can see a deal with Japan or Vietnam or, somewhere to show, no, he's playing his deals. You'd like to know who is responsible. Remember, it was Paul Ryan who ushered the first tax cuts through. Like, who's responsible for ushering that legislation through and championing that? That'll be very important because he's got to get those done. And the question is, how quickly can he get it done to calm the markets? Because what we've seen is, look at you, when you suddenly have CEOs who say, I can't give guidance because there's so much uncertainty, that uncertainty makes them fear, and then they stop making investments. If you stop making investments, it slows down the economy, right? So I think what we need to see in the next 90 days is some clarity.
In the meantime, uncertainty leads to a lot of conspiracy theories and lots of other types of speculation. As someone who oversees $1.5 trillion of assets, how much of a material shift have you seen with customers, consumers, shifting just slightly away from U.S. assets to insulate from some of the whipsawing and the uncertainty?
You definitely see non-Americans reducing, on the institutional side, some of their exposure to U.S. equities. Okay, so we've seen that a bit. But on the other hand, you sort of, if you are in the market now, this is not the time to get out of the market, right? You need to play this out. And if you hadn't made the trade to being in more defensive stocks, then there's no point in doing that now, right? Because you've already sort of missed it. So, the reality is AI. I actually played around this weekend with an app called Replit, where you can just use natural language processing to have it code and generate an app for you. Like, the efficiencies that are going to come from AI, we haven't seen those kind of productivity gains yet. The productivity gains that we're seeing are coming from technologies that came out 20 years ago. And so as those things play into companies, I think you'll see real opportunity.
One thing that I hear from you, and I heard from Mike Wilson of Morgan Stanley earlier this morning, was that corporate America has a lot of good about it in terms of strength, in terms of resilience, in terms of technological progress. It's the question about other dollar-denominated assets, and I'm talking about treasuries. I'm talking about government debt, especially given some of what you were talking about with respect to who is driving some of these budget proposals through Congress. That really is the issue. How much have you seen that bid get called into question as institutions, particularly foreign ones, move away?
Well, I think there's a question of, how much are foreign governments pulling away from treasuries, and is that what we're seeing in the treasury market, or are we seeing the unwinding of the basis trade? And so, look, then the question falls into, well, is the U.S. as the reserve currency a question? Look, it's not. Where else are you going to go, right? The U.S. is going to be the reserve currency. People will say, well, China trade has gone up 50%. Yeah, it's gone from 4 to 6% of trade, right? It'll chip away at it, but we are still going to continue to be the reserve currency.
You mentioned a lot of non-U.S. investors pulling back from the United States. Morningstar had research out this week that said some of that is actually patriotic rebalancing from capital from America to Europe. Do you think it's that emotional for some of these people?
Well, just again, talking to folks from Canada who are so fundamentally offended by the comment of, the 51st state, yeah, it's emotional, right? They kind of get it on the trade and tariffs, and we can deal, and you want help on immigration. But a comment like that has obviously had that kind of nationalist response.
What are the long-term impacts of feelings like that?
Listen, I was at a dinner last night. We were, debating, does that push Europe to China? I don't think it, obviously, I think what it does is there's the joke of, it's not MAGA, it's mega, make Europe great again, right? It forces Europe to do things like more defense independence, more energy independence. Look, there has been a lot of brilliant talent in Europe. Why are we not seeing these unicorn companies from a technological? And a lot of people would say it's the regulation and it's some of the policies that they have in Europe. And so if this forces Europe to be more resilient on its own, that's actually a good thing for Europe. I don't think they don't suddenly trust China much more. They're already trading with China. But it forces them to say, you know what, we have to stand on our own a little bit more.
It's why we've seen some investors rebalance towards Europe since the start of the year. I wanted to build on some of Lisa's questions, and I think this is an important line of questioning. At the moment, some investors aren't drawing a distinction between risk assets in America and the safe haven asset in America. It's trading as one bucket. Dollar-denominated assets. And I wonder, from your perspective, when that EM dynamic starts to take hold of a country, whether that's a risk you need to actively manage or a dislocation you take advantage of. Which one is it at the moment?
Well, I think any time that it becomes a risk-on, risk-off in a big block, and yet the underlying fundamentals are different in kind of an investment, that actually becomes a great investment opportunity. So I think you have to look at it and unpack those.
Do you think that's what this is right now? And is the opportunity in stocks or bonds with that in mind?
I think, right now it's almost a market reacting to just a headline statement, right? And so it's really sort of on and off. It's a risk on, risk off. I think that from the dollar was some would say overvalued, who knows, right? And it's come down a fair bit. I think there are a lot of people that were the U.S., the debt and the deficit, thought that it was overvalued. And so probably in this, there's a little bit of that coming, some of that frothiness coming off.
What's your advice to people right now who were part of that dollar bid? They've built up that massive dollar long over the period of a decade across asset classes in both equities and fixed income, and they're nervous about the policy in Washington and looking to reallocate. What are you suggesting they do? I
think it depends on where you're. If you're a dollar-based economy, I think that's okay. You don't have to worry about that. If you're not a dollar-based economy, you have to understand how that's going to impact your investments.
Certainly been something the Europeans have had to think about over the last few months, that's for sure. Jenny, it's good to see you. Lots to talk about. I can't imagine how much has changed the next time we speak. Jenny Johnson there, the Franklin Templeton CEO, on the latest in this market. Lisa, important considerations for anyone trying to manage a portfolio at the moment in 2025?
There's some big existential questions that a lot of people are saying, well, if you look at the companies, they're still producing all of this. A bigger question comes, the companies can be doing really well, but if you have currency risk and you have potentially fiscal risk or debt risk, that changes the equation, and that, I think, is the unknown.
The dollar a bit weaker again this morning. Euro dollar at the moment, 113.76, but some comfort in the bond market. We've said that repeatedly. Yields lower for 3 consecutive sessions. We're down 4 basis points now on a 10-year. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Yahara Hackers in New York for more. Hey, Yahara.
Hi, John. We start with shares of Procter & Gamble falling about 0.9% in the pre-market after the company cut its annual sales and profit outlook due to tariff uncertainty and volatility in consumer demand. P&G CEO said the company will likely roll out price increases during its next fiscal year, which starts in July, saying tariffs are inherently inflationary. Meanwhile, President Trump plans to celebrate the 100-day milestone of his second term in Michigan next week. Trump will highlight his tariff policies that he says are protecting blue-collar workers. His 25% levy on autos and auto part imports have been praised by the United Auto Workers Union. And Louis Vuitton raised the price on one of its most popular handbags after President Trump imposed 10% tariffs on EU goods. Analysts at Bernstein say the Neverfull GM bag in the classic canvas now costs $100 more, totaling $2,200. They said other U.S. handbags prices rose by 3.6%, but that not all products were affected, suggesting some may be made in the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Any excuse, right?
Any excuse, I guess. Although that handbag, the Neverfull Louis Vuitton handbag, you can go find at a lot of secondhand vintage shops.
Oh.
So you can get even better prices.
Or a visit to Canal Street. Is that still a thing?
I think so.
Down in Soho, maybe. All right, up next, the Morning Calls Plus. Carlos Cuerpo, the Trade and Economy Minister of Spain, on a US-EU trade deal. That's next from Washington. This is Bloomberg. Equity futures on the S&P 500 negative here by just 0.1% on the S&P. The opening bell is about 1 hour and 13 minutes away. The Nasdaq just about turning positive. Let's get you some morning calls. First up, Barclays lowering its price target on Southwest to $26, pointing to uncertainty as the company drops its 2025 forecast. That name is down in the pre-market by 3%. Your second call from Deutsche Bank cutting its price target on Meta to $6.50, saying tariffs threaten China's ad spending. Just a little bit softer there by more than 0.1%. And your third and final call from Bank of America cutting its price target on Apple to $2.40, citing increasing tariff uncertainty and delays in its AI-enabled Siri. A stock just slightly negative going into the opening bell. That's the price action and some morning calls. Let's turn to trade negotiations. Spain's Trade and Economy Minister, Carlos Cuerpo, signaling optimism about a US-EU trade deal after meeting with the Treasury Secretary, Scott Bessent, just last week, saying the talks were useful and constructive. Carlos joins us now for more. Minister, it's good to see you, sir. Thanks for being with us.
Of course, my pleasure.
Did you get an understanding of the ask? That seems to be a question we've all asked many times this week in Washington. Did you get a decent understanding of what they'd like from
I think
Europe?
That's actually when you start a negotiation, those are the initial steps in which we are actually living now through these negotiations. You know that these negotiations are led by the European Commission, Commissioner Šefčovič, We will also, on a bilateral basis, be engaging with our US colleagues, trying to get a feeling exactly of what their asks are and how we can manage to get to a fair and balanced deal, which is what we all want, I think.
Are you expecting a blueprint in the meantime before the 90-day reprieve is up?
Well, what we can expect in 90 days, I think, is an agreement in principle or a way forward to be able to actually then pinpoint the details of where this agreement would go. But there is time to reach this agreement in principle and to lay down a way forward which would lead to, as I said, a fair and balanced agreement. Because in the end, while we're negotiating, some or most of those tariffs for European companies are actually still in place.
When it comes to are the Europeans on the same page, though? You and a few other countries have decided maybe we should have the digital tax. Giving that up could be a bargaining chip. Is that still on the table right now?
Well, I mean, this was part of a decision that came within the OECD context, where we decided that basically those big digital firms that were providing services in our countries were not getting taxed in a fair manner because they were extracting those rents from the data that came from our citizens, etc. So as part of this OECD big deal, we decided to go ahead with this digital services tax, which is, I think, a fair and balanced tax that helps also run the public finances of our countries.
So at the IMF meetings, there's kind of a dismal tone among a lot of people. You walk in with a pep in your step. You're one of two economies that actually were upgraded in terms of the outlook at the IMF. What's going on? Why is the Spanish economy outperforming so significantly at a time when everybody has a great degree of uncertainty?
Well, it's great to add some note of optimism in these meetings, and it's good that Spain is actually leading the way in terms of good prospects and strong growth momentum. I think that's the key. Also, the IMF went this way. Spain has been outgrowing our main partners for the past few years, and this is also the way that it is expected to be in 2025 and 2026. For the second year in a row, in 2025, we will be the major economy that will be leading in terms of growth, and this is, I think, a great structural change for Spain.
A lot of my friends, family, have all gone to Spain recently, and I wonder how much this is part of it. Sort of U.S. travelers coming and vacationing in Southern Europe at a time when the dollar was strong, and now suddenly how much that's at risk of dialing back really significantly, given that the dollar seems to be weakening.
Well, tourism is part of that positive story. We've been reaching record numbers in terms of tourists, but it's not the whole thing. When we look at services and exports in services, the lion's share is about non-tourism services. Around 100 billion is services to firms like, of course, IT services, accountability services, accounting. So all of this is part of the success story of our external sector. And it's, as I said, 100 billion in exports versus 93, 94 billion in tourism. So that's the modernization story and the structural change that is actually happening. And what we expect in terms of tourism is still a very strong year in 2025, despite, as you said, a weakened dollar.
Minister, your Prime Minister has met with Xi Jinping recently,
yes,
the Chinese leader. I wonder what kind of message you think that sends to the White House at a tense moment for the Europeans with the US.
Well, you know, this has been, these relationship between the EU and China, these resetting or somehow really get into the sense that China is a rival and a competitor in many areas, but it has to be also an ally, a partner, a strategic partner going forward, has been going on for the past 2-3 years. And Spain is part of that, but it's an EU approach. And, you know, President von der Leyen will be in China also I think in 2 months' time. And this is part of this, trying to reduce the deficit that we have in our trade relationship with China,
sure,
trying to open up the Chinese markets, trying to also attract Chinese investments to Europe. And this is, and let me then go back to your question, of course, very complementary to what we want to do with the US. So the EU wants to be a key relevant player in this new setup of geo-economic relationships, and we want to strengthen our relationship with the US.
You can see me smiling. I struggle to see how it's complementary to go and visit Xi Jinping at a time where the United States would actually like to see many countries isolate China. Were you asked about that this week?
Well, I've been asked a lot about that this week, but what I can say is that you can also listen to the US administration say that they want to reach a deal with China, and we've been saying that the US and China need to talk, and that would be for the benefit of everyone. So I think, again, both elements are very complementary.
It was the Prime Minister's, though, third trip in 2 years. There does seem to be more of an outreach when it comes to Beijing. And at the time, Secretary Bessent said you could do this at your own risk, cutting off your own throat. Do you feel like you have to choose between Washington and Beijing?
Well, again, I think the EU needs to be a key player going forward. And that means, of course, engaging with the major economic actors, be it China, US, or others. What we're trying to do is also a big outreach to other partners. We closed a deal with Mercosur, which hopefully we will ratify throughout the end of the year. And we're reaching out to India, to other Asian partners, to also the Middle East. That's the way forward for the EU. And I think the understanding that European Union is a stable, reliable partner is also helping us on the way.
Are you concerned, though, with the U.S. having these tariff rates up, that China will then put more of its products on Europe and hurt your own industries that you're trying to grow?
Well, that's exactly one of the risks going ahead, this trade deviation that we might actually see happen when the U.S. market is closed or let's say less open to other products, whether it will be a trade deviation towards the EU. We're monitoring that on a constant basis throughout, of course, all EU countries to see whether or not this is happening. We do not see it in the data yet. But an element which is important there is to engage with those countries that might actually whose companies might be sending their products towards the EU, including China. So this dialogue will be part, of course, of our outreach to avoid this trade deviation, this dumping of those products in the EU. We will be ready to protect our industries there as well.
The word you used referring to China was ally. And I think that might irk a lot of people in the United States because China certainly hasn't been an ally when it comes to the war in Ukraine. And the United States has continued to provide a security umbrella, particularly for the Europeans. And they're very upset about the fact that they're paying a lot of money to do that at a time where the Europeans have maintained trade relationships with adversaries. Where does that word ally come from to describe a relationship with China?
Well, I mean, as I said, we need to partner up with key strategic economic actors, and China is one of them. And this is the way that economic trade relationships have been going on for the past few years, not only between the EU and China, but also between the US and China. There are trade relationships that will be maintained irrespective of the political cycles. And we need to get this element of stability and certainty to our firms so that the whole system is actually working. And again, I think the EU is on a constructive, on a positive path towards engaging with all major partners.
Minister, appreciate your perspective this morning. Thanks for being with us.
Of course.
Thank you very much. Carlos Cuerpo there, the Trade and Economy Minister of Spain. Up next on the programme, we'll get you some economic data, jobless claims just around a corner, and some reaction from Jonathan Pingle of UBS. And then later, we'll catch up with the Standard Chartered Chair, José Viñals, on the potential for lower levies on China. Some economic data just seconds away. All eyes on the labour market to see whether some of the tension in policy is beginning to show up in the underlying economy and start to give life to layoffs. The layoffs that we certainly don't want to see anytime soon. Equity futures going into that negative by 0.2% on the S&P. Virtually unchanged on the Nasdaq 100. In the bond market, things have settled down. Can we call it stability? 2-year, 10-year, 30-year yields lower by 5 basis points on 10s. Your 10-year, 4.33. With some economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. It's almost like the magic 8-ball for economists. Initial jobless claims come in at 222,000, which is exactly what the consensus forecast was. Last week's revised up to 216,000. The continuing claims number, 1,841,000. That's down a little bit from 1,878 in the prior week. Durable goods orders, though, this is quite a shock. 9.2% gain. Last month was 1%. The forecast was for 2%. But I think what we've got here is a question about where the gains were. And my guess is we're going to see a big Boeing number. I've got to look into the actual data to find that. Capital goods orders, non-defense ex-air, that's the one that goes into GDP. Every month we talk about that. Up 0.1% as forecast. So it looks like we've got an outlier somewhere, and I'm going to guess that it is in the Boeing area and perhaps in automobiles. But I'll have that for you in just a second.
Mike, we'll come back to you when you have that data. Might be key there, breaking things down for you. Equity futures at the moment, not breaking down, doing OK. We're negative by 0.1% on the S&P. Joining us around a table here in Washington, D.C., I'm very pleased to say, is Jonathan Pingle of UBS. Jonathan, it's good to see you, sir. You've got to help us understand this moment. This data is so hard to read at the moment. It's difficult to know what is a pull forward and what is just a reflection of a resilient economy. Which one is it at the moment for you?
Well, I think one of the things we're seeing right now is just, I mean, every economy is going to have a certain amount of momentum. It's going to take time for some of the weakness to show up, particularly in the labor market. If you think about, the decisions that firms have to make, they're grappling with a lot of uncertainty. Their first knee-jerk reaction may not be cut now. It might be wait and see. And I think that was what we're seeing. I mean, we're generally expecting that the labor market data is probably going to look okay through the May data. We've been expecting that it probably will soften relative to March. But that it's probably not really until sort of June, July, August timeframe that we really see, the impact of some of the uncertainty and the tariffs on the labor market.
Do you think that we will see that impact regardless of what happens in terms of any resolution going forward? In other words, has some of the damage already been done?
Yeah, no, I think it has. This goes back to something Annmarie had mentioned earlier, where, even if they're dialing back to kind of what was the upper bound mentioned on the campaign trail, which is actually still a lot of tariffs, right? And, when I marked down GDP growth this year by a percentage point, really partly because I don't have the crystal ball as to where the tariffs land. But if the bulk of these tariffs remain for the bulk of the year, the bulk of the economic damage is going to be done. And the economy was already slowing anyway. I mean, if we think about what consumer spending was doing coming into the year, the investment data didn't look all that great. It looked fine. I mean, orders and shipments held up today. But overall, the economy was cooling already. State, local government spending was slowing. Labor market was cooling. Now we're adding kind of a shock, and we can debate the magnitude, but I certainly think it's going to weigh on growth.
There's been this huge debate again between soft data and hard data, and will the soft data come up to the hard data, or the hard data come down to the soft data? Neil Dutta over at Renaissance Macro put out a really interesting point, which is a lot of the hard data is made look better than it has because of the bring forward type of behavior of trying to get orders and shipments before the tariffs went into effect. How much are you seeing soft data as having a much greater predictive power this time around than a lot of people are giving it credence for?
We have no idea. Okay, I don't mean to walk back your question. The soft data has been pretty terrible for forecasting in the pandemic and post-pandemic period. So I am kind of waiting around for the hard data, but I do think even with the pull forward, we can sort of see what's unfolding, right? We got a big jump in auto sales, people getting ahead of the tariffs. But I think that still signaled people were willing to spend money on cars. So the consumer was as much as it was cooling, it was sort of okay in March, and I think we'll have to see. But I think if you walk forward, even part of the price increases that we might see, if you think about what businesses are facing with the challenges in their supply chains, and for as much as the administration is carving out and walking back some of the tariffs, a lot of those carve-outs are only because they intend to tariff these products under other authorities, right? So, so this is a challenging environment, I think, for businesses and the economy, and I do expect it to feed through to the hard data eventually.
John asked a really important question yesterday. I was talking about my family being some of those individuals getting ahead of these big purchases. They're worried about prices going up, or they're worried about losing their jobs?
Well, I think you're starting to see a little bit of the latter. I mean, I think this started basically as people worried about the price increases and all the concerns we've had over the last few years over inflation. But I think you're certainly seeing, like when you look at the Michigan survey, for example, and the number of people who expect the unemployment rate to rise, I think you're starting to see that in surveys. People worried about their financial conditions, people worried about their jobs. And, we run some surveys of high-end consumers, and our softline retail analysts are starting to see some cracks even among high-end household spending.
So let's get into that, because that's important. The conversation we were having was basically if you're worried about losing your job, you don't buy a car. But for many consumers at the moment over the last few years, particularly the lower-income consumers, have been squeezed for quite a while. It's the upper-income consumers that have been robust and resilient and held up the aggregate numbers over the last few years, as you know very, very well. What kind of cracks are you seeing there now? And if we start to see some cracks there, some weakness, what would it mean for the broader economy? What's left?
That's exactly a point I've been trying to make. This is what the slowing coming into the tariffs kind of means. I mean, the expansion wasn't firing on all cylinders. I mean, upper income households were, carrying sort of a disproportionate weight in consumer spending. We've lost a lot of the impetus from the big wave of fiscal policy from the Biden administration. it was kind of a narrowly or increasingly narrowly driven expansion. If we lose those households, that's a meaningful impetus to growth. And we are seeing cracks in the surveys. You know, those are households that risk responding to lower equity valuations and a negative wealth effect. So I think that is actually one of the bigger concerns, is that this was an expansion that may have been vulnerable already.
So that vulnerability, how's it showing up at the moment? So we just had jobless claims still okay. Do you see anything to worry about the labour market in the real hard data at the moment?
The labour market's holding up pretty well. I would say, though, when I look at some of the forward details in sort of some of the job opening surveys we see, when we think about how low the hiring rate is, you know, some of the incoming anecdotes on layoff announcements, hiring announcements, a lot of that really has weakened. And if I continue to walk forward where that's headed and economic growth continues to slow, I mean, I'm sort of a traditionalist, right? Labor demand is, you know, function of product demand, right? So final demand is going to slow. I mean, I think labor demand is going to continue to slow as well here.
Wanted to finish on some final thoughts on the Federal Reserve and the independence of the central bank. I'm sure you've got lots to say. Given how they've set up the reaction function now, which essentially is to guarantee being late, isn't further tension between the White House and this FOMC just inevitable in the next several months?
You know, we did a deep dive on that last summer, trying to sort of look ahead at these tensions. And I think, you know, this is not a tension that's new to this White House and this Federal Reserve. You know, but clearly the administration has some economic goals they want to pursue, and the Federal Reserve has other economic goals, and they may not be well aligned.
Jonathan, it's good to see you, as always. Appreciate your thoughts. Jonathan Pingle there of UBS. I promised to revisit with Mike McKee. Mike, I know you're looking at that data. What explains it?
Boeing, one word, Boeing. Transportation equipment, non-defense aircraft up 139% in terms of orders. We also had some strength in automobiles. Motor vehicles were up by 2.3%. That's not as strong as last month's 1.5%, but it's still fairly strong. And we did see some strength in other areas that you might expect some pull forward. Primary metals, fabricated metal products do come up. Interestingly, though, computers and computer equipment, they fall 2.9% orders there. So there were some areas in which people are already starting to cut back. This is maybe the first hard data we can say that starts to match up with what we have seen out there in the markets.
Interesting. Mike, keep us on top of things. Mike McKee there on the latest economic data. Let's turn back to the trade story. China and the latest there, demanding the US to revoke all unilateral tariffs and denying any talks on a trade deal. Joining us now to discuss is a veteran economist, financial regulator, José Viñals, the chairman of Standard Chartered. José, it's good to see you, sir.
You too. Good morning.
You've quite literally seen it all in your time at Standard Chartered, the IMF, and the Bank of Spain once upon a time as well. Have you ever seen it like this before?
Well, I think that the uncertainty we're having is very high, but this may not be unique. I remember times, for example, during the global financial crisis, precisely at the beginning, at a month, September, October, here in Washington also, at the meetings at the time, the uncertainty was off the charts again. And we also saw a very difficult situation with COVID. So it is a complicated moment, but I think the world has gone through other complications and survived.
This is a policy shock, for sure.
Yes.
Do you see it morphing into a financial shock?
Well, I think that so far what we have is an impact coming from the tariffs, both in terms of the tariffs that are perhaps will be imposed, perhaps not. It will depend on the negotiations. But I think that what is unsettling is the fact that there is unpredictability regarding tariffs. And this is something which, as we know, is a deterrent to decision-making. So far what we're seeing are the economic consequences in terms of the postponement of decisions by households and also by businesses. And this complicated environment may be resolved for the better or for the worse. But so far, I don't think we have seen significant financial consequences beyond the stock market volatility that we have seen over the past few weeks, and also some interesting gyrations in the U.S. Treasuries market.
Which we'll get to in a second in terms of just how much that does affect stability. I am wondering, we are seeing, though, a pretty seismic shift in rhetoric in terms of what the ultimate goal is for the trade partnerships between the world's biggest economies. And for Standard Chartered, where 90% of all profits come from Africa, Asia, and the Middle East, How much are you seeing your clients materially shifting away from the U.S. at a time where there is heightened uncertainty and real questions about, say, that Treasury volatility?
Well, our clients are trying to, first of all, to figure out what's going on. And I think that one of the most important things that a bank like us can do at this time is to stay very close to the client and help the client make sense of what is happening to the extent that this is possible, and then help sort of advise them on what are the potential options that they have depending on how this ends up. What we see in our clients through our markets is that they want to continue doing business with the United States. The United States is the largest economy in the world. The United States accounts for nearly 15% of global trade. The United States will remain a major force in growth and trade. So our clients want to continue doing business with the United States, but they also, I think, are thinking about diversifying more. And all of these will end up depending, this diversification, on what is the ultimate outcome that countries are having in their bilateral negotiations with the United States. But I can tell you that if at the end of the day what we have is that there is a lot more friction in the trade between the United States and the rest of the world is going to increase further the economic and financial relationships that they have. And we have already been seeing this for quite some time, that if you look at the dynamics of global trade over the past 5 to 10 years, you have seen that the dynamism of trade among emerging markets far outweighs the dynamism of trade, with advanced economies.
So this actually raises the question that we've been talking about all morning. How much do some of the U.S.'s trade policies push the likes of Europe closer to China, as well as the rest of the developing world?
Well, I think that it's very natural that if you're doing less business or potentially doing less business with a particular partner, which may be very important, as the U.S. will continue to be, you may try to do more business to sell your products in other markets. And what we have seen in these few weeks is that a number of areas in the world are thinking about furthering their integration. For example, I was in Malaysia a few weeks ago. They were having the ASEAN +3 official meetings with ministers of finance and central governors. Well, the ASEAN region will pursue closer economic integration because there are more gains from trade that they can achieve by being more closely integrated. Asia has other regional trade arrangements which are going to be more important in terms of further integration of the different Asian subregions. And you have an increasing connectivity already between Asia and the Middle East. That is something which is very interesting. This is growing very, very significantly, of course, between Asia and Africa. It used to be China and Africa mainly, but now you see, for example, the Middle East also playing a very important role in terms of the connectivity with Africa. So the trade corridors are reshaping, and Standard Chartered is very fortunate to be sitting on markets which, are some of the most dynamic markets in the world. And we will see this further connectivity. And as a bridge bank, as a formidable super connector, we're going to be there to provide this further connectivity within emerging markets, but also do whatever we can to continue the connectivity with the United States.
What it sounds like from you, though, is that these trading partners, if the U.S. goes out and says, I want you to help us confront China, they're unwilling to do it at the behest of the United States.
Well, I'm not going to prejudge what the outcomes of negotiations are going to be because all of this is very complicated. But one thing I want to tell you is that there are many countries in the world which want to be on good terms and do a lot of business with the United States and with China and with Europe and with the UK and with Canada, so you don't want to choose. So the question is how you manage that. And there may be some trade-offs that you need to make. But again, I think it is in the interest of the world, first, that the global imbalances that we have could be reduced insofar as some of them may be unsustainable. That's something, for example, that the IMF has been looking for many years at these global imbalances, many, many years. So some of those imbalances, it could be healthy to address them, but on the basis of things which would be good for the national economies behind it, because at the end of the day, the external imbalances reflect the internal imbalances. And I think that all countries need to play a role in making that happen. So you need to have fair trade with lesser imbalances. And I think that trade is indispensable for the growth of the world. It's like blood to the body. We need to make sure that we preserve fair but reasonably open trade circuits so that the world can be moving forward.
You've articulated that argument quite strongly. It is not surprising to me or anybody else that a multinational wants access to multiple nations. The issue that we've got at the moment is that they might be forced to choose. And this isn't really new. I think China has made a point repeatedly that certain companies aren't welcome in their country. And then maybe the United States will take a page out of their book and do the same thing to other companies looking to come into the United States. And I just wonder, Jose, whether in 5 years' time, whether you really think we'll be in a position where they do have the ability to choose, whether that choice won't be forced on them, a choice between the United States or China.
Well, I think that there is the United States, there is China, there is India, there is the Asian region, there are the Gulf Cooperation countries, there is Europe, European Union and the UK, there is Africa. There are many different parts of the world. And even if there may be some constraints, which, by the way, already exists, because we have sanctions, we have export controls,
of course,
we have limitations to cross-border trade and investment flows on the basis of national security. Even if some of those may get a little bit larger, I think that it is ultimately in the interest of all countries, including the United States and China, to have an environment which, of course, takes care of their concerns, but allows U.S. firms to continue doing important business in China and China-related sort of countries, and for Chinese firms to continue doing business in places which are in the United States' sphere of influence. So I think that this should be the target. And listening, for example, yesterday to the U.S. Secretary of the Treasury talk about the possibility of a big deal between the United States and China, that is in a scenario that I think would be very important for the world. And the fact that this is mentioned by the United States, I think it's important. And I do hope that we sort of bring the souffle down in terms of these tensions, because the world economy and the people in the world cannot afford a continued sort of confrontation at this level in terms of a trade war between the two largest economies in the world.
We've certainly taken the temperature down this week, but things are still very hot, as you know. Jose, it's good to see you, sir. Thanks for being with us to share your perspective. Thank you. Jose Viñals there, the Standard Chartered chair. Up next on the programme, we'll run you through the week ahead in just a moment. For now, though, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hacker. So, Yahira.
Hi, John. President Trump pushed back against imposing a higher tax rate on millionaires, saying it would cause them to leave the country. The remarks could discourage further talks about creating a new 40% tax bracket for people earning $1 million or more. Lawmakers return to Washington next week, where you are, to begin discussions on a tax package. Meanwhile, Whirlpool shares are rising 2.5% in the pre-market. The company maintained its full-year financial outlook, saying the long-term impact of global tariffs will benefit its position in the U.S. home appliance market. Whirlpool saying tariffs will, quote, level the playing field by raising prices for foreign manufacturers. And Japan's major car makers, including Toyota, Honda, and Nissan, saw a surge in U.S. sales last month, with Americans rushing to buy cars before Trump's tariffs on imported vehicles kicked in. Toyota sales rose 8% from a year earlier, Nissan sales rose 10%, and Honda recorded a 13% jump. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead as we look forward to a busy close to the week in Washington. From Washington, this is Bloomberg. The open about 37 minutes away, and equities just about turning positive in the last couple of minutes or so. That's your price action right there, positive by 0.2% now on the Nasdaq 100. Let's get you a preview, a sneak peek of what to look forward to through the rest of the week. Here's your trading diary. Today, President Trump meeting with the Prime Minister of Norway. Then later on, we'll get earnings from Alphabet after the closing bell. Look out for that. Going into the weekend, UMich consumer sentiment, and looking ahead to next week. On Tuesday, JOLTS data and consumer confidence. On Wednesday, More earnings from big tech, including Meta and Microsoft, and slowly getting closer to a very important payrolls report not too far away.
Yeah, maybe the first where we start to see some of the ramifications from the lack of certainty that we keep hearing about. The earnings have been notable in terms of people withdrawing guidance and getting a sense that that uncertainty is starting to put on hold a lot of their plans for spending.
I'm looking for potential clarity, though, this week. Kevin Hassett said yesterday there's more than countries bringing in more than 18 blueprints to try to strike a deal. He said Ambassador Greer's in 14 some odd meetings. They're all in meetings this week on the sidelines of the IMF. And they say they want to get these blueprints out before the 90 days. So maybe we will have some certainty of who's getting deals and what concessions the U.S. wants to get to those agreements.
As finance ministers from around the world gather in Washington, D.C. for the IMF spring meetings for the World Bank, the situation looks like this. The temperature has been turned down over the last few days. And did it come off the back of a meeting with the biggest retailers in this country, Home Depot, Walmart, and Target, telling the president, reportedly, the prices are about to go up and the shelves are about to empty. Your coverage continues tomorrow live from Washington, D.C. We'll catch up with Nathan Sheets of Citi. We'll speak to Wally Adeyemo, the former U.S. Deputy Treasury Secretary, the IIF President, Tim Adams, and the NASDAQ CEO, Adena Friedman. Looking forward to being with you tomorrow in the nation's capital. Equity futures right now on the S&P just about unchanged. Your opening bell 35 minutes away. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.